All right, good morning, everyone. Good morning. Welcome to our webinar for tonight. Before we start, though, I want to do a sound check. Could you guys kind of see, or can you guys hear my voice? If you can, then just click yes. Then hopefully, all right. So that was quick. All right. Since I'm getting great responses from that, it should be all good. So, all right, so let's start our webinar for today. Hello, good morning to all of my attendees. Welcome to our webinar. So before we start the actual webinar, I do want to kind of bring you through, oh, 1 second. Hold on, yeah. I think I'm sharing the wrong screen. All right. It should be all right. So before we start, I want to kind of bring you through an introduction to Flip Capital, as well as the services and the products that we provide. So it would take around 10 minutes, so just real quick and get that out of the way. So first off, let's get started. So this is just a disclaimer that this presentation has not been reviewed by the Securities Commission of Malaysia and is not a recommendation to buy or sell any investment products. Hence, PCSB is not liable for any financial decisions that you may make based on the presentation contents. If you want to make any investment decisions, you have to seek advice from a qualified financial advisor, because investment is a very, very risky endeavor. All right. So basically, Flip Capital, right? We were incorporated on the 7th of October, 1995, and we are a wholly owned subsidiary of Flip Capital Holdings Sdn Bhd. Formerly, you may have known us as Flip Futures Sdn Bhd because back then we had only offered futures and CFDs, but now we actually have stocks in our list of products offered, right? Currently, we are a trading participant of Bursa Malaysia, as well as a participating organization of Bursa Malaysia Securities, and we are also a holder of the Capital Market Services license, which means we are legally allowed to provide you these services and these products. All right, so we have around 11 Phillip Investor Centers across Malaysia, which are our offices, with our headquarters located in Kuala Lumpur. So if you are nearby any of these branches, you can drop by and say hi, because we don't bite. So we have a lot of them in West Malaysia, in places like Kota Damansara or Malacca. In East Malaysia, we have offices in Kuching, Cebu, as well as KK. All right, moving on. So we have won many awards throughout the years, especially the Bursa Excellence Awards. We have a really strong track record. Just recently in 2022, we actually won the first runner-up for the Best Retail Derivatives Trading Participant, as well as the second runner-up for the Best Overall Derivatives Trading Participant. So this strong track record is very, very nice to look at. So yeah. All right, we have a wide global network with offices around the world in 15 different countries, all the way from Asia. We have Singapore, we have China, Japan, all the way to the Western countries like the US, the UK, Turkey, and France. So we are really widely separated and globally separated, situated within the world. Hence, we have a really wide global coverage, which means that if you want to trade any of the products in these exchanges, like the CME Group, like Eurex, ICE Exchange, JPX, Telcom, Hong Kong Exchange, and XGX, you can trade any of the products from these exchanges through us. So that's a lot of products. Wow. All right. So let's move on. So we are your one-stop solution for your trading, because we offer many different products. We have futures, things like index futures, interest rate futures, agriculture futures. We have the good old stocks. We have Malaysian shares, we have US shares, Hong Kong, Singapore, Australian shares, and we also have contracts for difference. Bursa CFDs, the New York Stock Exchange CFDs, Nasdaq CFDs. We have all of those. So these are currently the products that we offer. We are your broker of choice because, as you've seen, we have won many awards throughout the years. We offer 24-hour broking and execution support. We offer advisory services to our clients, as well as the latest market news updates and trends. And we also have a free, hassle-free online account opening process, which I'll get into later on. So you can learn with Flip Capital because we offer free one-to-one coaching sessions, as well as many free seminars and webinars, just like this one right here, which is top-notch quality, nothing bad to say about it. So yeah, in our free one-to-one coaching session, basically what we will be doing is we will be bringing you through a introduction to futures, CFDs, and stocks, which is mainly our product knowledge section. And then next, we'll bring you through our platform coaching, which is our session for the charting system practice. So if you are interested to register for our upcoming seminars and webinars, you can scan this QR code right here. I'll just give you guys a second to take a picture or screenshot, but you can also find our seminars and webinars on our websites, flip.com.my. So I'll just stay here for another 3 seconds and then I'll move on. All right, so next up we have our weekly market calls, right? So we have on the left the market views and updates, which is where our analyst will present his weekly views and updates on newly published reports, which is held every Monday at 11:15 a.m. by Flip Securities Research. And on your right, we have the live counter technical analysis, where our technical analysts will kind of bring you through the potential entry and exit levels throughout the week. Both of these are free to join, of course, and they happen every week. So, I'll just leave you guys to take a screenshot or, just visit our website to join them later on. All right, so here, if you are interested in opening an account with us, this QR code is for you to scan. It's completely free and it's easy and it's online. You can open your stocks, futures, or CFDs account completely at the comfort of your home. It takes no less than, maybe 10 minutes. No more than 10 minutes, sorry, no more than 10 minutes. So it's extremely quick and hassle-free. All right, so let's move on. So we have different trading platforms for our different products. First we have FlipNova, which is the platform that we trade, our clients use for future trading. It's a really clean interface, really simple, easy to use. And we have many good things like over 90 technical indicators. You can just click buy or sell directly from the chart, and as well as the market depth trading tool, which everyone loves. So this you can scan this QR code for a demo account. It's on the web as well as on the Google Play Store and the Apple App Store. All right, next we have Poems Global 2.0, which is our newly refurbished stock trading platform, right? We have your all-in-one stocks watch list, we have trading indicators and all of that good stuff. It is also on desktop as well as mobile devices. So yeah, you can find them on the Apple App Store as well as the Google Play Store. And the link to download the desktop version is also on our website. All right, so lastly, we have the Flip CFD Trader, which is the platform that our clients use to trade CFDs. You have all the stuff that you need to use to achieve success in trading, of the price alerts, live charting, and it's a really clean interface. All right, so next we have our promotional section. All right, so if you need any reason to open an account, this is probably it. We have the Trade and Earn with Philip, which is where you trade a minimum amount of brokerage, then you are entitled to win cool prizes like touch and go reload pins, Apple Watches, AirPods, or iPads. So you can scan this QR code for more information. It is ending soon, in December this year, but we have new ones later on in the year, so it's totally fine. All right, so that is pretty much it for the introduction. I will bring you to our first speaker of today, right? We have Mr. Jen Yuan, which is the head of research of Flip Capital Malaysia. He brings with him 10 years of sell-side industry experience covering various industries, including energy, petrochemical, manufacturing, and automotive in Malaysia. He is a fellow member of the Association of Chartered Certified Accountants, the SCCA, and is very experienced. Hence, we are very lucky to have him today. How are you, Mr. Chen Yuan? Hold on. Can you hear me? One second. Currently, I'm having some technical issues, but he's on the line. Don't worry. He's not gonna escape the webinar. Right. I think he will rejoin because I think that we're having some technical difficulties at the moment. So, you know, do stand by for just another minute or two. All right. But you know, we do have a large array of speakers today. All of them experience in their own individual markets, but just overall, the amount of experience is appalling to me, to be honest, as a, you know, just seeing this crazy lineup of experienced speakers for today, covering different markets, you know, from Malaysia to US to Singapore. It is an absolute astonishing sight to behold. So stay tuned. All right, so Chen Yuan is back. Let me check on him.
Morning, Brian.
Oh yeah, I can hear you.
Yep, morning.
All right, sure. All right, so I'll just pass it to Chen Yuan to present his section. I won't hold you guys for too long. Give me a moment. Yeah, I'll just pass it to him. All right, so Chen Yuan is now the presenter, and I will step down for now. Enjoy. Have a good one, Chen Yuan.
Okay, morning, everyone. I hope that everyone can see my slides. Morning to our fellow Phillip Capital investors, Genuine here. I'll be sharing with you guys our strategy for the Malaysian market this morning and how we are looking to actually position into next year. So without further ado, let's jump straight in. This is basically a quick summary of what we are planning to run through for the Malaysia strategy. I think overall, to set the tone, we are still expecting US recession to happen sometime near mid of next year, despite the earlier market expectation that US recession should have already occurred this year. But it's delayed, but definitely not something that should be ruled out completely. And our local market tend to follow the trend in the US. Essentially, S&P pullback will be felt for the local market as well. But our market tends to outperform during a global bear market, which I will explain in more details later. Okay, so with a little over a month remaining for the year, here's a recap of what has happened this year. US, especially NASDAQ, has done remarkably well this year. Japan has also done well, attracting the foreign investors on stronger corporate earnings. Economy is also showing sign of recovery. Taiwan, Korea, India, which I will go into further details later, are also among the market that has done well. If you move down the list, Malaysia is again among those that underperform, with the broader market actually down close to about 5%, despite a very strong third quarter, helping to narrow the losses. And this chart just shows you among the big caps what has done well and the sector. If you look over the past few months, we all saw many property stocks that has done well. Construction has done well as well. And in terms of big caps, at the bottom chart, you can see that in line with the broader market decline. Most of them are actually in the negative territory this year, with the exception of your Celcom DG, your Maxis, your Tenaga. I think most of the other stocks is performance is relatively quite lackluster. This is just again a recap. Some of the key indicators that we monitor. Oil price. It's now trade. I mean, at one point, oil price was trading above 90. Now it's back to the 80 US dollar level. But nevertheless, still a very good level. OPR has hiked about 125 basis point year to date. Your currency, I think that basically Malaysian currency has been weakening this year. This is a page which I intend to spend a little bit more time. Basically, it actually shows you the foreign equity fund flow of the Asia 6 market as well as Malaysia. If you focus on the column highlighted in the dark blue, you can actually see that the Asia 6 market has attracted close to about 10 billion US dollar of net inflow, with the biggest capital actually moving into the likes of your India and Korea. I think this is likely due to the AI excitement. If you recall, Nvidia has done remarkably well this year, which also saw Nasdaq perform well as well. Thailand actually saw the biggest outflow, close to about 5 billion US dollar. And likely that is the worst performing market in the Southeast Asia due to the political uncertainty, which has actually affected them. I think if you look in terms of the closer back to home for Malaysia, we saw about 3 billion of net outflow, almost wiping out last year's inflow of about 4.4 billion ringgit. But I would say that it's nothing new. Over the past 10 years, you can see that we saw actually 7 years of net outflow. I think that you can actually see this at the bottom right-hand chart, which is also probably one of why the KLCR has always been constantly underperforming the market. I will say that ringgit as well as our corporate earnings growth actually play a very key roles here. Both need to be a lot stronger before we may see the selling, gradually stopping or slowing down. Hence, this brings me to my next point. Despite the low foreign shareholding, which is what you can see at the top right-hand corner, is already at its all-time low. But we believe that it's definitely still early to call a bottom, because like I mentioned, it actually hinges on earnings growth as well as the ringgit direction. Okay, so from here on, this is where we will start talking in terms of the 2024 outlook. I think that there are a few key things to watch out for. US recession, like I mentioned, is delayed, but definitely not dismissed. US employment is still strong, but have seen the unemployment rate slowly creeping up. I think Fed funds rate is at a multi-year high and likely going to be staying high at least over the next couple of quarters. Inflation rate has come off, but nevertheless, I think that one of the headwinds that we of course see is the fact that US has actually been depleting their savings. Student has started paying off their debt, their student debts since October this year. Social spending is also expected to decline. So these are some of the macro headwinds that we see. Okay, if you look in terms of the valuation of the global market, I would say that it's by no means cheap. I think most of the market valuation, your S&P, your Nasdaq has come off its peak since the strong rally that we've seen since early part of the year. But even with the recent correction, I would say that both are still trading at close to its historical mean. And what's been driving the US market has always been a handful of the tech stocks. but something that should be on everyone's mind is the chart at the bottom. So essentially, this shows you the yield curve inversion. And we all know that yield curve inversion is a precursor of recession. And yield has been inverted since last year, July. So admittedly, it's overdue. And with this in mind, likely there is a possibility that investors may risk off ahead of this expectation. So like I mentioned, not to sound too negative on a Saturday, but I would say that in terms of Malaysian market will still stand out in terms of its defensiveness. On the graph on the upper right hand corner is actually the relationship between S&P and KLCI during a recession. Historically, you can see that KLCI tend to outperform during a pullback recession period, which means we drop less when the broader market has dropped more, right? And this time around, we believe that it will likely to be the same as well. I think firstly, there's really not much downside for the Malaysian market in our view. KLCI is already down close to about 5%, and supported by the healthy economic environment. If you look in terms of the consensus forecast, I think that they are expecting a 3.7 and 4.5% GDP moving into next year. So that should actually support the local market. PE multiples, which is shown here on the graph on the top, is already trading close to its -1 standard deviation below its mean. So while we are still expecting some volatility, we believe that KLCI will tend to outperform. And basically, if you look at what happened this year, the small mid cap index has outperformed the KLCI, 10% return for the small cap versus the CI of about 5%. I think this is why we are saying this is the fact that earnings profile for the small mid cap stocks tend to be a lot stronger compared to the large cap. And moving into 2024, I think that this would how we would like to position as well. And overall, we see a better opportunity in the small mid cap space to actually make some alphas. So moving into 2024. We have identified a few themes which we like and we think that it will be interesting. Basically, for 2024, we are overweights on the construction, the electronic manufacturing services, the healthcare, oil and gas, as well as technology. So for the construction, it's one of our overweight sectors. Basically, we are expecting news flow for this sector to actually pick up with a few highly anticipated projects such as the MRT3, the Penang LRT, the higher development expenditure spending in the Trust Malaysia plan. The midterm review has always been positive. I think that the construction sector is also expected to benefit from the growing data center investment, with states such as Johor becoming increasingly attractive. And the good thing is that data centers tend to have a relatively shorter turnaround time as well as a better margin. For sector exposure, we actually like Gamuda and Kerjaya. So basically, we have a buy call on Gamuda, target price of 501. Basically, we like Gamuda for the regional exposure for both the construction and property. Like we said earlier, Gamuda, in our view, is actually well positioned to secure some package from the MRT3 as well as Penang LRT. I think that most recently, the company has also won another Taiwan railway job as well as a hydropower project in Sabah, on track to actually achieving its 25 billion ringgit Malaysia order book replenishment. The next pick for construction that we like is Kerjaya Prospect. We have a buy call, target price of 169. I think that we like Kerjaya for its above profit margins of about 10 to 13%. It has also a strong clientele, such as the likes of your Gamuda, UEM, Sunrise, as well as E&O. And the next theme that we would like to highlight this morning is the EMS sector. I think EMS, it's largely on the trade tension theme that has seen Malaysia actually benefiting very strongly from this, as the global MNCs uproot their supply chain, manufacturing hub, and moving to Malaysia. In this space, we actually prefer the industrial over the consumer names. Few reasons. I think that the industrial players are well positioned within the secular trends, such as your AI, data centers, 5G optical modules, as compared to the consumer space, where we believe that the global end demand is still relatively fluid in anticipation of a potential US recession. For sector exposure, the first stock that we would like to highlight this morning is NationGate. We have a buy call, target price of 180. Essentially, like what we highlighted earlier, NationGate is actually a prime beneficiary of the trade diversion. MNCs have been diversifying the manufacturing hub to Asia, but even over the past few years, we have seen this scenario. But you only make up a low 10 to 20% of their overall market, suggesting actually further outsourcing opportunities for players such as NationGate. We also like them because they are strategically exposed in the 5G, the EV, as well as the data server space. And we will start seeing a gradual ramp up in terms of their first data server customer by over the next year. And they also have a very aggressive capacity expansion plan, where it's expected to increase by over 50% by end of this year, and another 30% for next year. So I other than NationGate, I think that this Cape EMS is also one of the name which we think that will be a very good alpha pick, something that we really like as well. We have a buy call on Cape EMS, target price of 190. I think that's similar to NationGate. Cape EMS also stand to actually benefit greatly from the US-China geopolitical tension. If you look in terms of the revenue estimate that we have by segment, we think that the EV segment growth will be huge next year, and will be a game changer. We foresee that this segment will grow to close to about 1/3 of the group revenue next year, from a mere 1% in 2022 last year. This company, Cape, will also benefit from an inorganic acquisition. I think most recently they announced that they intend to actually acquire this design company called Icon for 77 million ringgit. And it's being acquired at a 6x PE, which we think that is very earnings accretive, come with a 3 years profit guarantee. So for Cape, we are projecting a 3 years profit CAGR growth of about 51%. I think that compared to NationGate, Cape actually have a more aggressive expansion plan. They are expanding their floor space by 70% by end of this year, and we are very positive on the earnings. We think that we will see a higher demand from the trade diversion. We are also expecting margins to actually expand because of the favorable product mix, as well as more automation. I think among all of the EMS player, I think Cape is trading at a valuation which is far more attractive compared to the rest, and we think that it's too attractive to ignore. For instance, if you look in terms of KIP, they are trading at a forward 12 times PE, compared to, for instance, the rest of the player, which is trading above 20. And that is the reason why we think that it's actually a very compelling name within the sector as well. So moving on to the next sector, the healthcare. I think that this really hinges, the reason why we have an overweight call really hinges on the healthcare tourism. If you look at last year, I think that Malaysia has reported a 50% increase compared to the year before. And we believe that as the border reopen, more people slowly traveling back to Malaysia, we think that it's definitely a sector which people should pay more attention on. If you look in terms of the bed occupancy rate, I think that this is usually how investors assess the healthcare sector. I think that some of the hospital company has reported an increase in terms of the bed occupancy to about close to about 60% last year, compared to just a low 40% from a year before, and all this is definitely positive for the sector. Thirdly is the healthcare expenditure. If you look most recently from the budget 2024, you can see that the Ministry of Health actually saw the biggest allocation given to the healthcare sector, and we believe that this will actually benefit the public as well as the private hospital providers as well. I think apart from that, you can see that based on the forecast, we think that the public healthcare spending as well as the private healthcare spending is expected to increase from over the next 5 years, which will benefit the sector, like I mentioned. So for sector exposure, we actually like this company called UMedic. We have a buy call, target price of 92 cents. So essentially, UMedic is a well-established distributor of medical accessories as well as consumables, with over 20 years of presence in the industry. They actually offer a wide range of healthcare product, and most recently, currently, UMedic actually manufacture their own product, which is actually a pre-filled humidifier as well as the series inhaler. I think that for this stock, the key earnings growth is again their new plant expansion, which they will double the production capacity, which is very interesting. They're also introducing more new products. Most recently, they also acquired a new lab distribution business as well. So once, the new factory has already been completed, and this will actually double their current production capacity. So we believe that they are a beneficiary of the higher healthcare budget allocation, which I briefly mentioned just now. Budget 2024 allocation is expected to increase by about 14% next year to about 41 billion ringgit. Okay, moving on to the next sector, oil and gas. We think that the global oil price will remain high. We are looking at about $85 to $90 per barrel for the Brent global oil prices. I think that our positive view is actually backed by our expectation that the OPEC will continue to remain disciplined in terms of their supply. Stronger oil demand amidst the reopening, as well as a boost from the SPR, US SPR replenishment. So everything is pointing towards a good year ahead. High oil price, Petronas higher capex spending, the prior year under investment, as well as the global capex is also rising. If some of you actually follow the sector closely, you can actually see that third quarter results has been very strong and supportive of our view. And how we will actually position the sector year in, year out is really looking in terms of the Petronas activity outlook, which Petronas tend to announce every December. So year in, year out, your beneficiary tend to be in the hookup commissioning, your maintenance space, your rigs, your hydraulic workover, and some of the segment which are highlighted on the slides. So for a sector exposure, we actually like these two companies called Dayang as well as Pentec. So I will just highlight the first one first. Dayang, we have a buy call, target price of 230. Dayang is actually a market leader in the hookup commissioning as well as the maintenance space. There are a few reasons why we actually have them as a topics. Firstly is they are expected to benefit from the higher Petronas activities. We are projecting about 27% earnings growth driven by the higher work orders, as well as vessel utilization, as well as rates reversion. The order book is also quite sizable, and we have a target price of 230, like I mentioned. The second, which is a name that we actually prefer more due to the upside, capital upside for investors. We have a buy call, target price of 135. Basically, Pentec is actually a market leader again in providing pipes, valves, and fittings. And the story for this stock is really the capacity expansion. They are also a prime beneficiary of the foreign FDI. If you follow closely in the Malaysian market and what our Prime Minister Anwar has mentioned, I think Prime Minister Anwar has announced more than 100 billion ringgit of downstream petrochemical projects so far by some of the China players. We believe that this company will benefit very strongly from it. Pentec used to supply the pipes, valves, and fittings for the Rapid project in Johor. That is a project that is owned by Petronas, and as such, considering that they are actually a market leader in this space, we believe that the high foreign FDIs will continue to benefit them, and that's the reason why we have this stock as a buy. Like I mentioned, they are also benefiting from the Petronas. They provide a very good dividend yield. If you look at the table on the left hand side, yield is about above 7%. Hence, we believe that this should be something that investors should actually watch out for. So basically, I will not go through in details these two slides, but like I mentioned, these two basically is just something that is being announced by Petronas on a every year end. Technology, I think that next year will be a very interesting year for the technology sector. After 30% of decline since after 30% decline that we saw in the technology index last year due to concerns over the stretch valuation, slower economic growth, as well as a rising interest rate. I think that this year we continue to see the spillover effect, right? As such, if you look in terms of the technology index, the performance has been relatively flattish this year. I think that after 2 years of rather muted or underperformance, I think that next year potentially there will be a recovery. If you look in terms of the World Semi as well as the rest of the market intelligence has been guiding, they are looking for the market to actually recover next year. I think that the story for this year has been the fact that the industry was undergoing a inventory adjustment, which we understand that inventory is actually running low for some. As such, we think that the risk and reward is more is rather more favorable moving into next year. So how we would like to position into the technology sector is through this company called UWC. We have a buy call, target price of 431. Basically, UWC is pursuing more opportunities in the more profitable front end space. They are making very good headway within this front end space, and they are qualifying for more front end customers. And why we are excited about the front end market is due to the fact that the front end market is about 6 to 7 times larger than the back end market, which actually presents more earnings growth opportunity for UWC. As such, supporting our view, you can see that next year, that is the reason why we are forecasting, close to about 80% earnings growth for this company. I think that apart from the fact that they are moving into the front end, I think UWC is also expected to benefit from the industrial rebound, like I mentioned, as well as the supply chain diversification. As I mentioned in my earlier slides, the market is projecting a rebound next year, and coupled with the fact that there will be more relocation of more semicon equipment companies into Malaysia, we think that there will be increasing opportunities for UWC to actually grow. So just to sum up on UWC, basically the key earnings driver is due to the fact that they are expanding their manufacturing capacity by close to about 60%. They are also tapping into the larger and more profitable front-end market, as well as, like I mentioned countless times, the industrial rebound, as well as the increasing FDI to be attracted into Malaysia. So I mean, if this is actually the last slide that we have for the Malaysia market, so feel free to take a picture, just a bit of a recap. Essentially, if you guys listen to me, you guys will realize that a lot of our teams somehow have a capacity expansion story, and the market expected to recover. We think that some of these companies can actually ride on the expanded capacity and see a relatively healthy earnings growth moving to next year. So allow me to just do a very quick recap. Basically, in the construction space, we have a buy call on Gamuda Kerjaya prospect. In the oil and gas space, we have a buy call on Dayang Pentec. In the EMS space, we have Nation Gate as well as Cape EMS. In the tech, we like UWC, and in the healthcare space, we actually like UMedic. Okay, so that's all we have for the Malaysia market. And I will pass it on to Brian.
All right. Wow, that was a very, very in-depth and extremely well put together presentations. And I'll just stay on this slide for just a moment while I pass it back to me so you guys can take a picture of this. So actually the next segment that we have is actually the Q&A section, right? So if any of you have any questions that you want to ask Jian Yuan for the Malaysian market, you guys can actually put it in the question section. So we will have that one second, right? So any questions that you guys have, I will read it out to the speaker and he will answer your questions. All right. So first up, we have one second. Yeah, we have one question here, which is from Joshua. I'll read it out to you, Jian Yuan. Is that fine with you? All right. First, hello, Jian Yuan. Are you able to hear my microphone? Hold on, yeah, one second. All right, so currently, he is still on the line, don't worry. We will still continue with our Q&A section, but at the moment...
Hi, Brian.
Oh yeah, okay, so
Yep.
yeah, Jian is back, microphone issue is solved. So this is the Q&A section. Could you present the questions? All right, so yeah, any questions that you guys have, you can leave them in the question section and Jian Yuan will answer them. All right, so we're just giving some filter time to kind of allow the questions to flow in. Before we kind of answer them all. Oh, sorry.
Okay. All right. We have a questions on the yield curve. When do we expect the effect to actually come into play? So if I mean, I don't have the slides with me now, but basically, usually it takes about 13 to about 15 months from the moment yield is inverted to actual recession. And yield has been inverted since mid of last year. So admittedly, the narrative that we have is that the recession is definitely overdue, but we do expect recession to potentially happen next year. But we are looking at a slight mild recession. But of course, something that should be on everyone's mind is the fact that next year there will be a US some macro event that might take place. Hence, there is a possibility, that US recession might again be delayed. And there is another questions on the financial sector. I think largely, like I mentioned, Malaysia GDP is looking healthy for this year, next year. But we do believe that what we have highlighted, the sectors EMS, oil and gas, healthcare, construction, for example, I think that all these stocks have a much more interesting themes compared to the financial sector, and riding on this theme, we do believe that these names that we highlighted earlier will bring a much higher alpha compared to the financial sector. Yeah, I think we do not cover the plastic packaging industry, but I think Scientex is definitely the largest one. I think if you look in terms of Scientex earnings has always been driven by the twin engine, right? Which is their bread and butter business, as well as the property. I think that quarter after quarter, I think earnings has been quite solid. Okay, I think before the time run out, I will address one questions on the tech segment, on the tech sector. My apologies. We don't cover the likes of the DNEX, the Coraza, of course. But if you ask me, we much prefer the ATE space compared to the OSAT players at this point in time. And for now, we like UWC. Okay, there is this questions on the market. So basically, why is KLCI constantly or continuously being the worst performer? I think generally, if you look in terms of the FBM 30 components, it's largely the heavyweight is largely in financials, plantation, telco. So of course, admittedly, we do not have the sexy tech names within. And I would say that these are rather the so-called sunset kind of company. Sunset in the sense that I'm not saying that this company won't do well, but it's just not the more attractive tech companies. So with this in mind, we think that that is the reason why the market growth, the FBM, the KLCI market growth is not attractive, I mean, for some of the investors. And with that in mind, since earnings growth is not being very fantastic, and the fact that there are also ESG concerns, right? We all know that these three magical words have been playing a bigger part for the investors. And like I mentioned, plantation holds a very heavy weight in the market. So if there's ESG concerns, then likely that people are not likely going to be touching all this, preferably not going to touch on all these sectors. So it is a combination of earnings growth, ESG, and of course the ringgit. I mean, we all know that over the past 5 years, 10 years, 15 years, you know, the ringgit continue to weaken. So I think that these three reasons, it's also likely the reason why foreign shareholdings for our local market is currently below the 20%, which is all-time low. That's why in terms of direction wise, we actually prefer the small mid cap companies as compared to the big cap. I think that based on my chart, based on my graph, I did mention that over the past few financial crises, yield curve tend to lead to a US recession. Yeah, I think some of these questions relate to the US. I think that we also have a US presenter, so I think I better not take up too much of their time in terms of the US. Okay, I think that's all the questions that we have. Brian, over to you. Thank you.
All right, sure. Thanks, Chen Yuan, for the Q&A section as well as his presentation. So basically, if you guys have any questions for the later segments as well, you can put them in while they are presenting. But then the Q&A section will take part after each presentation slides. Segments basically. So now that we have finished with the Malaysian segment, let us move to the Singapore segment, which will be presented by our speaker next, which is Mr. Paul Chew. Now, Paul Chew has over 20 years of experience as a fund manager and sell-side analyst. As a fund manager, he has managed multiple funds and mandates, including capital guaranteed, dividend income, renewable energy, single country, and regionally focused funds. He graduated from Monash University and completed both the Chartered Financial Analyst and the Australian CPA programs. So today we have the head of research of Phillip Securities Research, Mr. Paul Chew, to present to us the Singapore markets. I won't take too much of your time. I'll just pass it straight to Mr. Paul Chew.
Yeah.
Right. Have a good one.
Can I just, yeah, thanks. Can I just do a quick time check? Can you just rephrase again, like how many, because the time is a bit early here, so what time do you wish me to end this, since there's I think a bit of change in the timing of the schedule?
Yeah, you could just follow whatever the flow is. It should be fine, you know, whatever's natural to you,
okay.
You know, it's the best.
Okay,
yeah.
Can you see my screen?
Can see you. Yep, it's
okay,
clear.
Sure. So thanks, Phillip Malaysia, for the invitation, and also thanks everyone for taking your precious Saturday morning. I will try and finish this in 15 minutes, then we can move on to Q&A. So actually we are referring more to fourth quarter 23-23 strategy, which we presented probably a month ago, but of course, obviously we updated it with as much latest data as we can. The theme behind our fourth quarter was really next comes the fiscal hangover. So what we are trying to the message we are trying to relay here is that initially US was supposed to slow down sharply this year, 2023, and even face a recession. But what happened was that the government spending or the fiscal deficit by the US was far better than anyone thought. Almost half the growth in the US economy comes from additional government spending. So that was what actually caught off guard most forecasters or even economists. So as the title suggests, we think there will be a hangover after such a huge spending by the government. Next slide. So our usual disclaimer, this is purely for educational, not financial advice. We may change our views. I don't know what nobody reads this, but let me just run it through you. It's our general circulation, and do seek advice from your financial advisor on the suitability of some of our recommendations here. So when we move on to the third quarter performance, which I've updated it more for fourth quarter, it's basically a bit of a snooze fest, both if you are bullish on the market and even if you're bearish on the market. So we'll just have a quick look at the performance of the various asset classes. They are in US dollar terms, so that to make it more comparable. So if you start on the left, Singapore is actually down around 4% this year. So far, fourth quarter really snooze fest, really nothing much happening. We're starting to see an improvement in the performance of REITs. So REITs have been hurt especially hard this year, especially last quarter. Third quarter was when most of the losses came, but we're beginning to see some recovery. APXJ basically means Asia Pac ex Japan, very heavy on China and India, obviously, and of course very heavy on the Chinese tech stocks. So beginning to see a recovery. US has been the stand-up performer, both on S&P and Nasdaq, and that makes our job a bit harder because US stocks right now is absorbing a lot of liquidity from not only Asia but I think globally. So virtually, whenever we want to promote any stock, you virtually have to compare it against a US stock, be it Facebook, or which my colleague Ambrish will discuss later. So you can imagine the challenge we have if you want to promote a stock, any stock, let's say the semiconductor front end, and the depth that we have to explain and so forth compared to anyone just broking Facebook, where everyone understands what this product is, or even a Netflix. So it's becoming extremely challenging if you are trying to promote stocks in Asia, because US easy to explain their household names and they're absorbing a lot of liquidity. And not only that, they're also growing much faster. Obviously, I'm not promoting US stocks, but that is the challenge most of us face whenever we are discussing any stocks. We virtually have to benchmark it against the FANG stocks or the so-called Magnificent Seven. The other thing that has performed well, if you look at the bonds have recovered. I think right now we are starting to see the market pricing in an easing cycle, or at least at the very least pricing in the Fed, the interest rates having picked up. So that's why you're beginning to see bonds and also REITs, the interest rate sensitive assets starting to recover. Gold was a bit curious, as gold should have, when interest rates peak, they should have actually corrected, but actually it's still improving. A lot of it by central bank buying. Commodities in down. We usually don't add KLCI, but this is a Malaysian crowd, so I just added KLCI just for reference. In terms of the next slide, because it's again a Malaysian audience, I show this in every slide, not to say the ringgit is weak, but just to give you a historical perspective. If you do look into Singapore stocks, this is one advantage we had. I can't forecast the currency, but some of the strengths that the Sing dollar has is that, of course, we have a very strong FX reserve of almost 500 billion. We are the only Asian AAA rated sovereign debt or sovereign rated country in Asia, and our bond yield is still pretty high, still like 10%. And the one in the middle you see in red is basically historically, if you want to have a rough gauge, historically at least, how much the Sing dollar has appreciated, is around 3% a year. So every year, on average, the Sing dollar strengthens against the Malaysian ringgit by around 3%. Just a rough gauge, obviously, it doesn't mean that this will replicate in the following years. So we usually start off with some macro themes just to get the investor to be aware of the environment. They are not really forecast, but at least just to give you a mindset of what's happening macro-wise. So the first theme is that there was a big fiscal boom. That's why the US performed so strongly, in particular the third quarter, that kind of surprised the whole market. So the most important chart, I guess, is this very unassuming chart. This is basically the US government budget. So the blue line here shows the deficit as a percentage of GDP. So you notice the blue line collapse a bit. So basically what it meant is that the government, US government, has spent almost 7% of the GDP to support the economy. So there was a lot of stimulus, and because of the stimulus, the government spent almost 7%. This is of course far higher than during the global financial crisis that you see here, 2008, 2009. And even though the curious thing was that even though the US right now has full employment, employment is virtually the lowest unemployment in decades, but the government continues to spend very aggressively. For us, this worrying. The data here that you see here is it's actually here is around 7%. During the pandemic, my apologies, the government spent almost as much as 20% of GDP, even higher than during the global financial crisis. If you want to look at the absolute numbers, the government compared to a year ago spent extra $1 trillion into the economy. So what we mean is that they collected less taxes, but they spent a lot. A lot of it is actually, which we will discuss later, social spending, but we'll discuss later. So this is not a presentation about US government finances, and we usually don't even look at it. Because if you look at the normal years, the US government finances range probably about 5 to 6% of GDP. But even though we have full employment, the government spent a huge amount, and which is very unusual. So what it means is that if there is a slowdown, you could see this blue line coming to almost 10%, 11%. And the key point I wanted to say was that the government, at least for 2023, spend an additional 4% of GDP. And if you think the US economy is growing maybe 6% or 7%, nominal terms, including the inflation, half of the US growth comes from government alone. And I think that is the reason why the US economy, all indicators point for a recession this year, but it didn't happen because the government was spending a lot. There are a bit of nuances. One of it is actually in California, because of the disasters, they actually didn't collect any taxes from California. Usually April, they push it up to November. So you can imagine it's like in Malaysia, you don't collect tax for the next 6 months. So obviously the budget here, the deficit here will balloon, and we're talking about almost 400 billion. By November onwards, you'll see the collection, and we think that is also one of the factors that will shrink the US economy, which we didn't put in a slide because these numbers are very hard to collate. The other thing to note of is that we usually hear in the US, jobs is fantastic. They added almost 300,000. But if you look at the types of jobs that's being added, in blue line is the government jobs. So as we mentioned, government is spending a lot. So there's most of the jobs you see here is actually from government, healthcare and social work, which for us isn't very economically sensitive. Because if you need to go to hospital, you need to hire for health, you need social, it doesn't really matter how well the economy is doing. Likewise for government jobs, it really doesn't really matter on how well the economy does. But if you look at the jobs that are economic sensitive, you're talking about manufacturing, construction, and so forth, you can see that the big slide here. So even though jobs are doing well, but it's not really a reflection that the US economy is doing well. The US economy is actually weakening just on the headline. So as the title suggests, if you look beyond the headlines, actually job additions are actually falling if you follow the red line. And we think as we enter into 2024, we do see multiple drags to the US economy, although most are expecting recovery, but we think that, there's downside risk to the US economy. Firstly is the excess savings. So when the pandemic happened, excess savings here means, assuming the US consumer saves as a total maybe 100 billion a month, I don't know, roughly just pulling out one number. But because of the pandemic, the government threw in almost 4 to 5 trillion, depending what numbers you want to use. But at the very peak, the US households had almost 2 trillion of savings in their bank compared to how much they save. But as the pandemic stimulus wind down, you can see that the savings continue to drop. So right now they have less than 400 billion. They're drawing down these savings. There's a refresh of this data because it does every 5 years. But if you assume they have been spending almost 100 billion of their savings every month, we think the excess savings, these are estimates, there's no like scientific number because it's a purely estimates. We think that this could run out by probably November, by probably February, January, February, the excess savings could actually wind down. So this will actually draw down a lot of the consumption. This will impact the consumption of the US consumer, because you have less savings. Obviously, you will spend more. So that's the number one drawdown. Number two, okay, this is a very unique thing. So in the US, most people collect Social Security. So you collect Social Security if it's like a retirement savings, retirement benefits, depending if you have paid in the past. So almost, I think, probably 8 in 10 US citizens in the US get Social Security. It can range to 1,000 plus to 2,000 a month. But what happens is that this thing called COLA, so COLA is not Coca-Cola, it refers to the cost of living adjustments. So what it means is that they actually adjust for you, so it's very nice of them. Your inflation is high, so okay, you're a retiree, I'll give you more money. They give out almost 1.3 to 1.4 trillion in Social Security every year. So these are very important because it goes straight to the consumer for them to spend, for retirees to spend. So you notice here there was a big growth in 2022 and 2023 because of that. But we think there's going to be a drop. They already mentioned it because inflation is down, so there will be like 100 billion drawdown. So all this, of course, this alone, we're not going to pull the US economy to slow down, but this is another drag that we mentioned. Excess savings is down. Secondly, the Social Security, which is a big stimulus to the economy. You're talking about 1.2, 1.3 trillion of Social Security spending a year. That is given straight to their pockets. Then the other thing is, of course, student repayment. So during the pandemic, the Biden administration said, no, don't have to pay student loans, so yippee. But then now, sorry, you have to pay. They wanted to forgive the debt, but the courts didn't allow. So you're going to see at least almost another 200 billion, 100 to 200 billion of student repayment, which, why this is important, is going to draw down on the US household spending. And of course, interest rates, we know, you're beginning to see this bite because in the US, the households don't have to, their interest is actually capped for 30 years. So of course, the households in my interest loans actually stuck at 2%, so it's still doing well. But this will slowly start to creep up, especially for the corporates. And it's beginning to hurt capital spending. So your capital spending in the US is also not growing well, despite there was this, there were a couple of stimulus packages, but that's also starting to shrink. I didn't add that in the slide, but just to say that interest rates will start to bite for the US corporates. The theme for 2024, we think would be interest rate cut, because we think US is going to slow, and we think there's an interest rate cut coming. Okay, so this is a very noisy chart. So just to give you, so this is basically interest rate expectations. So this is not my forecast, which is probably going to be wrong. So this is where the market is forecasting. So if you look at June, so June was where the market was expecting. So in June, just to give you how you read this, is that in June, the market was expecting, let's say by December 24, interest rates was going to hit like 4.1. But because of the FOMC meeting, and then and also the bond market started to climb, it spiked up to almost 4.6%. So if you recall, last month there was a big jump in bonds. And one of the reasons was because of Fed rate hike, and also there's a lot of bond issuance, which I think we can, I won't go into that to detail here. But the main message for us here is that in 2024, the market is starting to price in 3 rate cuts. We are not so optimistic. We don't think there's going to be 3 rate cuts. We think probably there's going to be 1 rate cut only by 2025, because the government spending is still quite accelerated. The government is still going to spend quite aggressively. So we think a rate cut will happen in 2020, in the fourth quarter of 24, and we think this is going to be the main theme for next year. Because if you are going to 24 in a slow environment, the biggest catalyst for investors is going to be a rate cut, and the pricing of the rate cut into the stock market, into all asset classes. The other reason why we think a rate cut will happen is that inflation is starting to come off. Based on the trend line, so this is not our forecast, this is we just extrapolate, like all analysts, we like to extrapolate things. So the last reading was like 3.9, 3.7, but if you extrapolate it by middle of 24, inflation could actually come close to the Fed's target of 2%. And why this is important, it also means that the Fed will have more leeway to cut rates, because they're going to say, oh, I actually hitting my targets, and I think we can actually give room to cut rates as the economy is slowing. So these are the trajectory, and this is where we forecast why we think there could be a rate cut coming into the fourth quarter of 24. So anyway, just for US, I won't run through too much. I will save more time for sectors and topics. But for Singapore, just to give you a quick update of what's happening in Singapore, one thing positive, it doesn't mean it's going to be more crime in Singapore, but one thing positive is that the population actually grew very strongly. This is one of the fastest growth in more than in a decade. And we had actually, it doesn't sound much if you're a Malaysian audience, but for us it's a lot because it's our population about 5 million. So we actually grew about 5%. And why this is important is that when population grow, it's going to be vibrant for land transportation. It's going to be good for supermarkets, basically retail homes, good for property market. And we are actually still below our forecast. So in 2013, the Singapore government had a forecast of where the population will be by 2030. So the range is 6.5 to 6.9 million. We are building infrastructure for around these levels. But if you trendline it, we're actually not hitting that 6.5 yet. So there's actually room to grow. So we think one positive thing for Singapore is that the populations will start to climb back up. And this is, of course, good for the whole economy, especially property and so forth. The other thing is, of course, we have ample reserves. The headline numbers doesn't suggest so, but actually we transferred almost 270 billion Sing dollar to the GIC or government coffers. So actually, if you add that back in, the FX reserve for Singapore is almost 500 billion. So when the pandemic came here, our reserves were about 283, and then it started to climb up very sharply. The blue line is the reserves. You notice the big drop here, but actually most of it was because the MES transferred the money to some of the sovereign funds that we have, namely GIC. Hopefully they make good use of it. The other thing that is the strength of Singapore is, of course, we are one of the few AAA rated sovereign debts, which I mentioned. This is important, not Moody's actually, but Fitch. Since Fitch cut the US, we are one of the few. You'll notice our debt to GDP is very high, but even the rating agencies know that this is mainly, we issued debt mainly just to get a benchmarking, because most of our fiscal, we try to balance our budget almost every year. So except for when the pandemic happened, but Singapore government's budget is always usually balanced. And this excludes some of the land sales that the Singapore government, this purely on revenue and from investment income from the sovereign funds. But in terms of the cyclical, in terms of the near term for Singapore, because we are GDP, our exports to GDP is almost 400%. So we are very reliant on global growth. It has been weak. It's starting to improve a little, but it is still weak. I think, although you will notice that it's starting to climb back up, but because last year was so terrible, but when you compare to 2019, when I look at some of the export numbers, it's only up 3% compared to 2019. So the headline might say that the exports are recovering, but it's because it fell so bad last year that there will be a recovery after 12 months. But it is still very sluggish. Exports isn't growing very strong. So imagine 2019 to now, exports are up 3%. So it virtually means that it only grew 1% the last three to 4 years per annum. So it's still very sluggish environment for exports. The one thing that's very strong for us is the tourism. So tourism is important. Tourism is 5% of GDP. And tourism, although you would think that it's come off a bit, but because this is there was a big spike here because of some events. I think also because I think it's Golden Week, but Golden is October, sorry. But what is helping us is actually the Chinese tourist arrivals are very strong. It used to be, I think, a year ago, Chinese tourist arrivals was only 10,000. Now it's spiked up almost 20 times to 200,000. It's still below pre-pandemic, but tourism is the one that's helping. So if you see the jump here, you're talking about maybe 30–40% growth, and it's still below the pre-pandemic 1.5 million. So tourism is another strong foundation to the Singapore economy's growth, because it's like 5% of GDP, and we're not a very strong high growth country, 1 to 2%. So 5% is actually very, very important for us. I'll next move on to some of the sector trends that we see in Singapore. We cover lots of sector, but I'll just pick one. We just have a handful. So we start off with banks. So banks is important. Our index, almost 40% of the index comes from banks. So what has helped the Singapore banks has been the net interest margins, which is what we call NIM. And why NIM is important is because in Singapore, 70–80% of our loans are variable rate. So when interest rate rise, the banks will immediately price it off. That means the banks will immediately charge their customers the higher rates. And Singapore interest rates are very closely linked to the US. So if you look at the blue line here, the Fed funds rate, as you can see, it climbed up very sharply, and the SORA, which is our so-called equivalent of the US LIBOR and so forth, is now called SORA. And you can see that it has a very high correlation to US rates. So when US interest rates rise, we have like maybe a 90, depending which period obviously, but we have like a 90% correlation to the US rates. And once the rates rise, you can see the orange line, the NIMs, the net interest margins. So the banks had a very good run in terms of earnings. Their earnings grew almost 40–50%. Just one of the rare times the bank's earnings growth is almost as good as the tech stocks in the US. But that's because of the high interest rates and the improvement in NIMs. We still think we're not expecting NIMs to collapse. We think NIMs will kind of stabilize at 2.14 compared to 2.16. If you look at the results of some of the banks, which we still have overweight. So you look at the banks, the profit continues to be very strong, except for UOB. UOB has some they kind of did some hedging on their net interest margins, so that's why their NIMs didn't grow as much. You'll notice here net interest income, but most of the two other banks, DBS, they grew their net interest income by double, high teens, and also their earnings also grew by almost 20% as UOB. But we think earnings will start to slow down in the fourth quarter because you're not going to get this kicker, because the banks did a huge repricing of their NIMs from the fourth quarter of last year. So when you come to this year, of course, the base effect will kind of loosen, will not improve. So that's why they also increased some of their provisioning. There was some increase in provisioning. It's not here, sorry, but the asset quality continues to be very, very healthy. You're talking about 1.2% NPL ratio, which is basically nothing. And there's a lot of NPA means out of the provisions that you make, how much assets are back behind it. So there's out of the NPLs and how much provisions you back out. So we've more than provided. The other part of the banks, why their strength of the Singapore banks is the amount of equity that they need. They usually only want 13%. Regulatory, I think, is about 8%, but they only need like 13.5%. So that's why we think the main story for the banks, which we'll discuss later, which is OCBC, is mainly the dividends. So OCBC is paying 6% dividends, which we think they can sustain because they have more than enough capital, and they have too much capital. And if they hold too much capital, it's going to affect their return of equity, and of course, it's going to affect the CEO's compensation. So obviously, it's good for them if they can if they can pay more dividends and also to bring down their ROEs. So I'll move on to REITs. We probably have a few slides on REITs. So for REITs, one attraction is that because of the high interest rates, you'll notice that the REITs valuations actually dropped a lot. They're actually almost to record lows on the price to NAV. So why REITs have been you can see the price, the de-rating of REITs. So I think this is pretty obvious, but let me just remind everyone how REITs get hurt. So when interest rates rise, so of course REITs get hurt, number one, because interest expense goes up, and then it will affect their DPU. So they can't pay as much distribution. So that's one, the dividend is affected. The second way REITs get affected is that when interest rates rise, the valuations will also get affected. The so-called cap rate. So obviously when interest rates increase, the cap rates will have to rise, and then the valuations will come down. So it's almost like the opposite of a bond. And the second thing is that when interest rates rise, the bonds will look more attractive, compared to variable rate bonds, obviously compared to a REIT yield. So REITs, Singapore REITs used to trade about 4%, but because bonds obviously rose, then now Singapore bond yields are roughly about 6%. So you get a triple whammy when interest rates rise. The reason why we bring this up is because if interest rates reverse and interest rates get cut, you're going to get the reverse, and you're going to get the triple boost to the whole re-rating of S-REITs, which we think can happen next year. The other thing is the S-REIT yield spread. This is a bit more technical. So what it means is that if you want to own a Singapore REIT, so right now you will get a dividend yield which is maybe 250 basis points higher than the bond. So just for simplicity, if a 10-year bond is giving you 4%, then the REIT is giving you 2.5% higher. So obviously, the REIT should give higher return because compared to a government bond which is sovereign backed. So the average is about 300 basis points. So right now, we wouldn't say it is like ultra attractive compared to historical, but if interest rates come down, then I think the attraction will come because the REITs can actually grow the dividends even better because when their interest expense come down. The other thing is why DPU, without stating the very obvious, is to give you a flavor of how interest rates affected S-REITs. So this is how the performance of some of the REITs, because every REIT has a different year end. So we just give you a sense of how they perform and why, even though they did very well. So if you look at Ascend, if you look at Escort, so Escort is one of the fastest growing DPU growth. So their DPU or their net property income. So net property income is basically the rental collected, the net amount of rent that they collect after paying property expense. So their net property income, that's the rental they collect after expenses, is actually did very well. It's up about 30%. But because interest rates rose so fast that even with a 30% growth, you can only grow your DPU by 20%. So if you look at the rest, so some grew their net, which is actually very difficult to grow. Imagine you grow your rent by 10% or 30%. Even you grow 10%, but because interest rate rose so much, your DPU didn't even move. So you can imagine if your MPI goes down, then how badly your DPU grows. So this is just to give you a sense that one of the things plaguing S-REITs was that even though they did well in growing rental, but the interest was just spiked up too fast and too high that the interest expense jumped from 30% to some almost as high as 70%. So you can imagine, yeah. So that's why it was so very difficult and challenging for a lot of the REITs to actually grow dividends. But if interest rates get cut, then obviously you get the benefit. The one REIT sector that we favor the most is actually hospitality REITs, mainly because hotels are still going up. And if you look at this chart for Singapore RevPAR, so RevPAR is almost equivalent to sales because RevPAR is your room rates times occupancy, because you can't just put room rates here. It's not going to be reflective. What about occupancy? What if your occupancy is only 10%? So obviously you're going to get lower revenue. So RevPAR is just a balance of revenue and occupancy, and you can see it's actually a record highs. So regretfully, if you come to Singapore now, you're probably going to pay record level of room rates. The hotel rates are at record levels. You can see from here is probably trending about 250, 270 compared to the pre-pandemic, probably about 180, 190. And that's why, and all this goes straight to the bottom line, and that's why hospitality sector for REITs is one of our preferred sectors because they're enjoying tremendous growth. So in terms of air transport, so air transport for us is Singapore Airlines, and of course we also have some of the supporting industries like SETS. So SETS is whenever the plane lands, they will come in, clean it, and they'll provide food. The other transportation that we have is SING Engineering that does the repair of maintenance. So we are actually underweight on air transport, mainly for SIA. So for us, we are underweight SIA. Firstly, because if you look at Asia travel, which is where SIA most of their flights are, is already coming close to pandemic levels. It's almost like 87% of it's almost 87% of pre-pandemic levels. Sorry, my apologies. It has up about 87%, but in terms of pre-pandemic, it's just down. It's just 10% below pre-pandemic levels. So sorry for that mistake here. So what we worry is that competition. The main reason why we're underweight SIA is because competition is coming back up, especially from the China airlines. So because China was the slowest to open, so SIA had like a one year head start compared to a lot of the Asian peers, because they could fly faster. They have flights which other airlines didn't have. But now that the Chinese airlines are coming back up, so we worry competition is coming, and that's why the yield, which is another way to say the margins for the SIA, is coming down quite sharply. So that's why we are not underweight on SIA. In terms of electronics, so for electronics, we are also we are neutral on electronics. The main reason here is very strange to use retail sales, but in the US, they are not spending on electronics. A lot of it is on services. So the main problem for electronics now is the end demand is still weak. In Singapore, we are very heavy on semiconductor equipment supplies. So the three main stocks in Singapore is the UMS, Franken, AMM. They are mainly into semiconductor equipment. And the only thing doing well in semiconductor equipment right now is China. Why we say China? Because China, the US put a ban on China, so the Chinese semiconductor manufacturers are stockpiling a lot of semiconductor equipment, and this is probably going to end in 2024. So that's why we end in 2023. That's why we're worried by 2024. Even though inventory has returned, the demand is still very low. The second thing is that the only thing that's doing well on semiconductor these days is only artificial intelligence, AI, which is virtually the NVIDIA GPU chips. So NVIDIA GPU chips, which you put, if let's say you go to ChatGPT now, you want to ask for any funny message you want, most of the processing is done at the cloud using the NVIDIA chips. But this market is probably probably like a 50 billion market cap size. But because each chip is almost 30,000, the volume is only 2 million. So it's not going to move the needle for a lot of the whole semiconductor equipment. So semiconductor equipment now faces two challenges: underutilization of the capacity, because last year they spent so much on equipment that right now not much of it is being used. Utilization is very low. And the second thing is, like I mentioned, end demand is weak. So that's why we are still although we're neutral, we are turning a bit more bearish that don't expect any recovery until the very tail end of 2024 for electronics, and in particular for Singapore semiconductor equipment. So I'm just going to move on to some of our stock picks. So we usually do a model portfolio. So we try to pick our 10 best stocks that we have, and we try to have a very balanced portfolio. And then so we balance our model portfolio by yield. Singapore is all about dividend yield. You'll notice that we didn't have much of it because interest rates are coming down, but we're probably going to raise the amount of risk that we have in our model. And we try to look for stocks that have dividend or earnings growth, which is very rare these days, but we still had growth in some of these names. And also re-rating plays. So re-rating plays are stocks that we think the market needs to re-rate. So like for instance, Singtel, I know telco is not the highest growth sector, but what they're doing is they're selling almost 6 billion of assets. So that's what we mean by re-rating, and we'll try and elaborate a bit more. We took out SGX and CDL because SGX, actually the earnings growth, but a lot of it came from interest income, which we were expected, but the market is still very bearish because the volumes are still weaker than expected. This is just a illustration of the performance, our rating, target price, share price, upside, and dividend yields. And our performance that we measure doesn't include dividend yields. So let me just run through some of the stocks. Some of these might be familiar to most of you, but let me just go through some basics because some as a Malaysian audience, some may not know these companies. So the first one that we have is called CapitaLand Ascott Residence, Ascott Trust. So basically they are REIT, but they focus a lot on service apartments and also student accommodations in the UK. I think they have like 106 properties, if I'm based on my last count and based on memory, but it's all over they're all over the globe. So what we like about it is the yield is attractive of 7%. The stock got hit a bit because recently they took a placement at 102, and because the placement didn't go well, so that's why the share price has been underperforming. But we like it because the yields are attractive, number one. Number two, they've got a very strong franchise. So it's called the Ascott brand. So the Ascott is very strong under their parent CapitaLand, which is growing their keys. There's almost like more than 100,000 keys globally. and this will give them a pipeline to grow. Excuse me, and that's the second reason, that there's room to grow because the sponsor can inject more assets. And the third reason is again, it's just the beneficiary of the whole of the growth in hospitality, which we think the next phase is going to be China, because China virtually locked down. We're only seeing the arrivals of tourists only the third quarter of this year. So you have another 3 quarters of growth from tourist arrivals out of China. And the other fourth thing we like about it, it's not on this slide, but because most of their assets are actually in very centrally located, because if you have a service apartment, you can't be putting it on the suburban. Most of them are in core city centers. So in the past, they managed to sell some properties in Japan, some properties in Korea, even at 50% above valuations. And like you probably heard this joke before, no, you either sack the valuer because he did such a bad job, or there's a lot of hidden value in the assets. So we think there's a lot of hidden value in assets because these assets usually are sold and then they can change of use and they become development properties. So that's why this company is also trading below book, and the book has a lot of value because most of these assets are actually centrally located. This is just an illustration of the growth in the RevPAR. We don't call it RevPAR, for them it's Rev per unit because they're not hotels, but you can see that there's continued to growth, and we think the growth should continue even into the next 3 quarters as we get tourist arrivals and maybe a little bit more of the large conferences, because large conferences didn't really occur, at least for the hospitality or MICE industry, probably only but maybe middle of this year, because as you know, COVID only ended maybe in 2022, and most organizers didn't want to organize any large conferences because you're not sure, because there were so many shutdowns. So only 2023 you started to see a lot of the big events coming in, which we think will continue into 2023. For Singapore especially, it's going to be a very strong year in 2024 because in January we will have, I think, Coldplay concert. Then in February we're going to have a major air show in Singapore in February, which usually runs every 2 years. And then of course in March we have the very famous Taylor Swift concert. And in April, for whatever reason, I do not know why, but there's a Rotary Club, I think Rotary or event or something, which is actually a huge event for some reason which the hospitality people told us. But so that's why first quarter of 2024 is going to be a very robust year for Singapore hospitality. Okay, the other one, which I think most may already know, we always share this because this is a very stable REIT, although the yield isn't as high as the rest, but because most of their assets are in very prime locations. So most of them are in a mall, in suburban areas, and in very high population density areas. So you look at this green color. So these are the high density, which for Singapore is a lot. And one thing about the malls in Singapore is that they're very well planned. Not say well planned, they're very well controlled. So most of the malls here have a monopoly for the next 2 kilometer or more radius. So the authorities here won't put a mall next to each other, and they'll try to spread out all the malls because they do not want to have a very huge concentration of malls. So it also benefits a lot of the incumbents, because once you have a mall here, there's no competition for you. Anyone staying within that radius, whether you like it or you don't like the mall, you have to go there. So that's why they're almost like monopolies in their own catchment areas. So we like it because they are very well located, all with MRT stations, the so-called 9 locations they have. And most of them are on essential services. So most of their tenants is F&B, supermarkets, lifestyle malls, and so forth. So if you are, like we mentioned many times in the past, if you are a novice, you're not sure which REIT to buy, so we always recommend FCT. You may not have like super growth or so forth, but it gives you a very strong stability. So we're looking at maybe 4 to 5% kind of rental growth or DPU growth for Fraser Centre Point. So the focus is on essential services. OCBC, really nothing new. I think most of us know, especially Malaysia audience, there's a OCBC. So there's not much introduction, but the strength here is the continued dividend yield. So they pay right now it's almost 6% dividend yield, which we think is sustainable because we think earnings can sustain, and because they have a very high CET1, a lot of capital to pay out, and earnings next year will be supported by fee income. and also stable margins, which most of the banks are actually guiding. Okay, so this one is a bit of an unknown. It's called Capital Land Investment, is CLI. We put the acronym here because the spelling's too long. It's a very unique company. So we don't usually like to put a lot of words into our charts, but if you look at this, it's very unique. It's like the next generation property companies. So most developers are into you develop a piece of land and then you sell it. But this company is different. They're more into the fund management. So the earnings are more recurrent. So that's why they actually own almost 6 listed funds. So most of the capital and escort that I mentioned, they actually mentioned, and these are very high quality fee, because when you manage a REIT, you hardly get removed because it's so difficult. And then you have private funds that they manage almost 30 billion lodging, because they have like we mentioned here, 162,000 keys. Sorry, my mistake. It's more than 100,000. So these are the escort service departments. So they're building like a mini Hilton inside this business, but it's mainly on the Somerset business. And also they have they actually own assets too. So that's why we like it, because they own almost 35 billion of their own assets. The share price didn't perform well, mainly because of this, because they're in China and because the whole interest rates were down. They do a lot when they make transactions. They actually earn extra income. But we think in 2024, as interest rates stabilize and China starts to get re-rated up, as the conditions in China start to improve, we think that this thing could re-rate stronger into 2024, because this is a very unique business model too. And most developers that you talk all want to be like want to have a model like capital land investment, where you have an empty piece of land, you develop it, then you develop it into a mall, you tenant it out, then you make money by developing it, you make money from renting it out, then you make money from after you sell it into a REIT, you can still manage it. So you make like 3 times your money on just a piece of land. So that's why we think it's a very unique model, but performance will be weak because of the high interest rates in China. The next one that we like is ST Engineering. So it's very hard to get a stock that has a defense sector on it. So if you look at this company, it is riding on 2 areas that's growing very well. Firstly is defense, and I think we all know what's happening in the world right now. So a lot of the defense budgets are climbing, and the phenomenon right now is that a lot of countries are also stockpiling on defense. So they're growing not only because budgets are up, they're growing because of what's happening around the world. A lot of countries also building a strategic pile of defense equipment. They're also benefiting on the commercial aerospace, because of course flights are coming back, so more planes need to be maintained. But there's one thing happening behind the scenes which is unique in the industry, is that because there's some issues with some of the engines. So a lot of the Pratt & Whitney engines are all there's a major refurbishment on a lot of the engines right now. So that's why they're going to get a sharper earnings growth this year. Okay, I'm going to push a bit faster. So one of the reasons that supports them, this is the Singapore's defense and security spending, the blue line. So you notice that ST Engineering's order book also moves in line. I mean, for very direct reasons, now ST Engineering's biggest customer is the Singapore Defense, and that continues to grow. It's very stable recently, but I think the last few years you will notice it's starting to climb up even higher. So not only do they spend on physical defense, also cyber security, which ST Engineering provides. So that's why we like it, because we think the growth is going to accelerate the next 1 to 2 years, especially in this environment where there's so many conflicts around the world right now. The next one we like is ComfortDelGro. I didn't put the introduction chart here, but for because it's a 15-minute presentation, but for ComfortDelGro, we like it because ComfortDelGro, for those who do not know, they are the taxi operator in Singapore and also bus operator in UK. They are not the most sexiest thing to try and promote a taxi company, but what has happened is that they were affected when Grab and so forth were introduced in the market. But what has happened now is that they came up with their own app, and they're starting to grow. So the last quarter, the earnings grew about 40%, mainly because you can see they're riding on these ride-hailing trips here, because they move they're trying to move more and more of their passenger traffic into ride-hailing, which is basically like your Grab and Gojek here in Singapore. So that's the first reason. Second reason is that They were hurt very badly in UK because they had to take on a lot of costs in the UK because there was a bus strike and they had to push the salaries up. And only right now they're getting the repricing of the contracts. So that's why earnings growth it will grow 40%, and I think they can grow another 20-30% next year. Because they're getting repricing, as they mentioned here, pricing is starting to recover for them for buses and also for taxis. Because when Gojek came in, they lost a lot of taxi drivers, but right now they become a very strong competitor to Gojek and Grab. They have their own apps, and in Singapore right now, it's not about having the car right now; it's having the drivers, and they have the largest. They have a large driver pool of about 9,000 taxis, and also about I think 600-700 of ride-hailing apps. So they become a very formidable competitor to the apps and to the ride-hailing apps, and that's why we have a buy call on it. Singtel, Singtel, why we like Singtel is that there's a price recovery right now. Last 2 years has been especially bad for a mobile operator because there's so much competition. But right now, you can see right here, this is India, and then this is in Indonesia. That pricing is starting to come back up. It's not coming back up for Philippines and Thailand right yet, although competition has shrunk in Thailand from 3 to 2, mainly because the economy is slow. So in these emerging countries, where a lot of it is prepaid, you really depend on the economy improving. So when the economy improves, you can price higher. So that's why in India, you can see the pricing is stronger. So we think pricing will come back in Philippines and also in Thailand. Not to mention, so that's one part. Operationally, we think there's a stronger performance. The second part for Singtel is that they are also looking to cut almost 600 million of costs, almost 200 million a year. So that's the second reason. And the third reason is that they looking to divest 6 billion of assets. They've already done 2 billion. So they're going to divest 4 billion of assets and return it to shareholders. So it's not only an operational recovery, but there's also a lot of re-rating potential as they divest assets and so forth. So we also have some recent initiations. So one of the REITs that we initiated on is called Suntec REIT. So this is probably the cheapest Singapore REIT that is out there with Singapore REIT with Singapore assets. So if you are not familiar, if you come to Suntec, so the assets are mainly in Suntec, which is a huge mall and office building, just slightly off the central CBD. When I say central off, it's probably like 5 minutes walk, but it's still considered slightly off. But why we like it is because it's one of the few Singapore assets with very good assets, and it's trading like only 0.5 times book, 0.6. So why is it trading so low? So one of the reasons it's trading so low is because they didn't really hedge much of they're one of the few REITs that didn't really hedge much of their interest. So that's why the DPU came off quite sharply. I think DPU came down almost 20-30% because they didn't hedge, and because they didn't hedge, they repriced a lot of their loans at the current spot rate, which will benefit them next year, when interest rates start to come down, because they are a bit more on the floating rate kind of fixed income instruments compared to the rest, which were hedged only 70 or almost 80% of their book. So that's why the thing it dropped very sharply, even below pre-pandemic. And we think that they can, and because once your valuations come down, then you get the spiral downwards, because you come close to the gearing level in Singapore about 50%. Then you cannot. It's a bit. Then because of that, the gearing is very high, so it causes a bit more worry for investors. But we think one big catalyst for them is, of course, if interest rates come back down, and secondly, they're starting to sell assets. So they're looking to sell about 100 million of assets, which can actually bring down the gearing. So that's why if you're an investor that wants something cheap and also attractive yield, so for us, we like Suntec REIT. Okay, so the other one is also we also initiated on Valuetronics, which is contract manufacturer, or EMS. That's what you call it in Malaysia. So we like it because we think it's downside protected. So this stock almost 90%, which you probably think is very unusual, but it's one of the cheapest stock around in probably the whole Singapore, because 90% of their market cap is in cash. So their market cap about 220 million. Their cash is about 200 million Sing. Why the share price did very poorly is because they had only one factory. Most of their factories was in China. And then because when the trade wars came out, it took them 5 years to build a new factory in Vietnam and to get like customers. So firstly, very cheap valuations, about 5-6% yield. The 90% of the cash market cap is in cash, and the downside protected. Another reason is because they want to return a lot of this cash. They have announced like they have another 60 million worth of share buybacks. The volume of this stock is probably like 1 million a day, so they can, if they continue to buy back very aggressively the shares. So, and they have 60 million of shares that they can buy back. So for the next 2 months, they can just be buying back buy back as much as they probably buy like 200,000-300,000 worth of shares. So they probably have a buyback for the next couple of months. And of course, no point talking about it if there's no growth. So they also announced four new customers. That's why we think there's going to be growth is going to recover for them. So that's why this is probably one of our higher conviction stocks. Because there's growth, it is extremely cheap. If you take out the cash, they're probably trading like 2 to 3 times PE. The last one I think I have is China Aviation Oil. So again, when we say China, I think most people were probably not willing to listen, but this one we have very good visibility on earnings. So China Aviation Oil is basically, they do a lot of trading of oil, which I think is not the most sexy, but the key part for them is that they own a air fueling depot in Shanghai. You can think of it like a petrol kiosk. The only petrol kiosk in Shanghai Pudong Airport for international travel. So any plane that needs to leave China needs to use this kiosk, and they made almost 80 million at the peak. So right now they're making about 20 million. This stock is trading like 40-50% in cash, and we think earnings can grow almost 50%, because as you look at this chart, the international travel from China is probably like 50% compared to the pre-pandemic. So we think from these levels you could easily double the earnings. So that's why there's very good visibility, and our target price is about $1. And the number of aircraft movements is 30%, because they are the main, any planes that fly out of China and they import oil actually comes from them. It's a state-owned company. Their role is to source fuel oil from all over the world and bring it to China. The profit is there, but the biggest profit, like 60-70% of it actually comes from this Shanghai Pudong Airport. So that's why we like it, because there's very good visibility. As if you want to play on the return of travel for China, it's virtually a tax on anyone that's traveling out of Shanghai Airport, which is the main international airport in China. So I'll just run to the conclusions. We think the economy in US has been sprouted by fiscal deficits and credit cards, which we didn't show on the chart, but we think all this is going to reverse, and we think US is going to face another slowdown because of the excess savings, COLA, and so forth. We are cautious on Singapore equities, but we are anchoring it around dividend yields, non-cyclicals, and probably one more missing here is stocks that have got good earnings visibility. Okay, I think these are our analysts, and so this comes to the end of my presentation. I think I will stop sharing, and I can move on to any questions that our attendees may have. Okay, Brian, have I stopped sharing? I'm not very familiar with GoTo.
Yeah. Start sharing your screen.
Okay, that's good. Okay, so that I don't share anything unusual.
Yeah. Okay, so yeah, that was the very in-depth segment from Paul. Much thanks to that. It was really well put together, and the slides are really clean. You know, that's something I want to comment on. So slides were really clean and easy to understand. So yeah, you know, we've moved on. We are going to move on to the Q&A section now for the Singapore market. So if you have any questions you want to ask Paul, you could just drop them in the question section, and then he'll get to your questions. Here we actually have two, I think. Would you prefer me to read it out for you, or would you prefer?
Yeah, you don't mind, so I just worry I can't. Yeah, thanks.
Yeah, okay. So the first one is, why are US market indices like the S&P 500 rising while the STI remains stagnant, especially for our local banks in Singapore?
Oh, okay. So the US is rising mainly on for three reasons. I think broadly speaking, you obviously have the Magnificent Seven because of the whole tech run. So the technology sector ran. I think Ambrish will share more. Technology sector ran in the US. I'm talking about the Facebooks and so forth. Not only because of the whole phenomena around artificial intelligence, but these stocks actually cut a lot of costs. And because of that, the market re-rated a lot of these the FANG-Ms, I know, which I think Ambrish will talk about later, the Facebooks, the Googles. So that's why the US, because of the tech sector, and tech sector is only like 2% of the STI, so we didn't catch the benefit. Second reason is that there was in the initial fears of the US was a very sharp slowdown. But the narrative now is about soft landing, and you saw the third quarter GDP was, I think, 3%, if I'm not mistaken. And that was another reason that re-rated the stock. And there was also another worry that, you know, there were the three bank closures in the US, but because the Federal Reserve also came in and supported a lot of these banks. So, but for Singapore, most of us, 40% of the index is banks, but I think without a very strong interest rate hike, the market has derated the banks, because then there'll be one less driver to earnings growth for Singapore banks, which was mainly the interest rates. So that's the long-winded answer. Yep.
Okay, well, all right, that's a great answer. Okay, we have one more question, which is, will the property market in Singapore crash like what is happening in China, affecting Singapore REITs?
Yeah, so we don't think it will crash. So I'll give a few reasons. The first reason is how the banks lend. So in Singapore, they actually enforce a 60%, they call it TDSR. So you can consider like a 60% of your income must be available to finance your loans. So the banks are very tight on the LTVs. It's mandated by MES. It just slipped my mind what's the ruling on LTV. I think 70%, if I'm not mistaken. So you actually have two safeguards. All banks, there's a minimum that they have to meet that's imposed by MES or your bank and the direct equivalent. Firstly is the LTV. I slipped my mind, apologies for that, but it could be 70% maximum. And then there's also 60%, I think, to your total income. So you can only use at most 60% of your income to repay your debt. So there are a few safeguards to that, so that you cannot over leverage. The third reason is that the government has been very fast to impose cooling measures. So those who may not know, but in Singapore, if you're a foreigner, you want to buy a property, you have to pay 60% additional stamp duty, additional buyer stamp duty on top of the price. Let's say you buy a home for 2 million Sing, you have to pay another 60%. That is 1.2 million on top of the 2 million. So the authorities have been very fast to impose cooling measures. Whenever property price goes up double digit, so once it crosses 10%, you can be pretty sure the authorities come in and clamp down. So that's why we don't think it will crash like in China, because the gearing is controlled. In China, just to give you we did some number crunching ourselves. China's property sales peaked at about 15 million. We think it could probably, it's now about 9 million. We think it probably stabilize at 7 million. Because one thing you like to use is the number of marriages. So the number of marriages in China is probably like 6-7 million, but you sell 15 million homes. So no, it's pretty sure there's a lot of even if you take into account urbanization in China, you're pretty sure there's a lot of speculation there. So that's why we think yeah, that it won't be like a bubble.
All right. So we'll move on to the next question is, oh, hi Paul, thanks for the presentation. Do you foresee an upcoming global recession in the global economy, and how might it impact REITs and other sectors in Singapore?
Okay, we think so very important to when we talk about recession, it's not just the economy contract. most important is you need to monitor whether you got this vicious downward spiral. So what I mean is that the worrying thing is that once the economy contract, do you get production is down, then because sales is down, then production has to be cut, then production be cut, then employment has to be cut, then employment has to be cut, then sales down, then you get this really vicious downward spiral. We don't think this might happen because the unknown is the government. So we think even if we do get a recession, it's going to be very mild. So what the point I'm trying to say is that it's not just recession. You have to watch whether even if recession, but it might just bounce back or just stay at these levels. Very very lackluster growth, 0.5, 0.3%. No better than a recession. But you have to monitor whether do you get this downward vicious cycle, which we don't think will happen because we think the US government is just going to give another blank check because they keep on continuing to spend on deficits. So unless there's a lot of political pushback on giving off deficits, we think the US recession, even if it does happen, is going to be very mild because the government is going to underwrite any deficit, any recession that's coming up. Okay, I think I got this last one, which I'll answer because I think I'm just worried about time. You want me to read it out, Brian? I think I can. Okay.
Yeah, sure, you can read it out.
Okay, the next question is also how intense are Singapore markets and Malaysian markets closely linked and correlated? Okay, we are actually going to issue a report, mainly by our technical analyst. He's going to show the decade, the winners and losers the past decade. Regretfully, when we did some of the quick numbers, I think over the last decade, that means over 10 years, we want to know, was it a lost decade? Which markets faced the lost decade? So I think over the last 10 years, I think KLCI is probably down about 20%. Singapore is up maybe 3% or so. Local currency, we didn't put in the US dollar, but do look out for the report. It's just a number crunching thing. I'm not going to give reasons. The link is not very high because if you look at our banks have very little exposure to Malaysia. So Malaysia to a typical bank is probably 10-15% of earnings only at most. DBS doesn't even have a presence in Malaysia. The only thing that links between Malaysia and Singapore is the performance of the electronics companies, because most of our electronics companies, virtually all have some production base in Malaysia. So the link is more indirect. Another link is maybe palm oil. So we do have some stocks, maybe Wilmar, but Wilmar's index to STI is very small, like 3%. So the link isn't very high. Because everyone has their own, especially because it's very heavy on financial, so they have their own idiosyncrasies. So I don't think the link is that correlated. Although I never really done the numbers, but we are very localized news, and also we all follow US in a way.
All right, okay. Sure. So I don't think there's any other questions, and due to the time factor, I think, yeah, that's pretty much it for.
Okay. Thanks everyone for yeah. So thanks everyone for your time and for spending your time and your questions. Thank you everybody, and have a good weekend ahead.
All right, thanks, Paul. All right, so I'll just pass it back to me. Okay, so thank you, Paul, for the Singapore segment. And next, we will actually move on to our final segment of today, which is actually the US market, which will be presented by our speaker for today, Mr. Ambrish Shah, who covers the US technology sector, focusing on software and services companies. He has close to 12 years of hands-on experience in conducting in-depth fundamental analysis and writing research reports of the analysts to provide prospective investment ideas. Ambrish earned his MBA in finance in 2010, and he is currently the equity research analyst at Phillips Securities Research. So I won't keep you guys for too long once again. I say this every time, but I'll just pass it straight to Mr. Ambrish. All right, so yes, we can see the
Thank you,
slides.
Brian.
Thanks, Ambrish. Have a good one.
Yep, thank you so much. So I would be running through some of the US macro and sector themes, and would also go through some of the key stock picks for 2024, particularly in the technology sector. So this is just a gentle disclaimer that the webinar is just for the educational purpose and should not be considered as a financial advice. So in terms of the content for this session, we would be running through the how the market has performed so far in the fourth quarter and the in 2023, and then we would be running through some of our macro and sector themes, and then would run through some of the key stock picks that I mentioned earlier, and they would mainly revolve around the themes like the digital advertising, cloud, AI, and electric vehicles. A short conclusion, and it would be followed by the Q&A session. So let's jump in and see what has happened so far in the markets in the fourth quarter. So basically, the S&P was up by about 6% in the so far in the fourth quarter, whereas it's up this year by about 18%. And we think that most of the gains, it's mainly because of the big tech companies like the Fangam companies or the Magnificent Seven, which basically involves Tesla, Nvidia, and the big tech like Facebook, Apple, and Amazon, and so on. So most of the gains for S&P, we believe that it comes from the Fangam. Like Fangam is up like almost 66% so far this year, and we believe that this is mainly because there is a recovery in digital advertising, as well as the cloud spending has bottomed out, and most of the companies, they have also integrated AI into their product base, and because of the AI, it was also up by about 66%. So we believe that if we strip out the Fangam or Magnificent stock returns, S&P 500 maybe would have been just up by about 5 or 6% for the year. So the major component is the Fangam. And meanwhile, the commodities was down by about 6%, and we believe that this was mainly because of lower inflation and lower oil prices. So in terms of which sector performed well, it was obviously the technology and semicon. They are up so far in this quarter by about 12%. And the reason, like I mentioned earlier, like there's recovery in digital ad, and also most of the companies, they have reported their third quarter earnings recently, and they have reported a boost in their earnings, mainly because the most of the tech companies, they have focused on to boost their bottom lines, mainly through job cuts and real estate consolidations, mainly because of cost cutting initiatives. So whereas if we look at the bottom, the energy sector, it was the laggard, and it was down by about 6%. And we believe that the biggest reason was the downtick in the oil prices. In terms of valuations for S&P 500, we believe that it's currently overvalued right now. So like it's trading one standard deviation away from its 20-year moving average of 18 times. However, if we still go further, like 30 years or 40 years, the moving average, it would come down to 15 or 16. So there was a time earlier this year where the markets had peaked, and it was the valuations, they were almost beyond its 1-year standard deviations. However, over the last few months, we have seen a pullback in the markets. So this does not mean that the markets would not move ahead. It's just an indication that we believe it's into the overvalued territory right now. So if we think that why there was a pullback over the last few months in S&P 500, that we believe that one of the reason was the treasury yields, they have continued to climb. So if we take a look at this chart, the orange line, it's basically the 2-year treasury yields, and it has remained flat from the period of March 2020 to 2021, and it was low, whereas the S&P 500 returns, they have continued to climb on top of it. So what has happened was basically when the Fed, they started to raise their rates, the treasury yields, they started to rise, whereas the S&P 500, it tend to wobble, and as a result, there was a pullback in the equity markets. So let us now take a look at some of the macro themes. So first of all, we think that Fed is going higher for longer, and this is mainly because Federal Reserve Chairman, it has mentioned that it would maintain a more restrictive policy instead of easing so far. So why, if you take a look, like why Fed is having a more restrictive policy, this is mainly because the core inflation, it has still been sticky, and the currently core PC, it's about a 4%, which is still double the Fed's target of about 2%. So basically, when we talk about inflation, there are basically two things: services inflation, which basically includes our housing, rent, hourly wages, transportation, healthcare, and so on. And there's goods inflation, which basically includes durable and non-durable goods like laptops, clothing, furnishings, and cars, and so on. So goods inflation, it was basically at a high of 10% at in July 2022, but it has come down, and it was high mainly because of supply chain issues, but it has now come down. Whereas the services inflation, it's still trending high at about 5%, and we believe that one of the biggest reason for this is the housing housing market, mainly because of higher mortgage rates as well as higher home prices. So moving on to the next chart. So like currently the Fed's funds rate range, it's about 5.3%. So it's at the peak of the core inflation, which was about 5.4%. And we believe that the Fed funds rate, it should be hovering over the next few months around 5.3 or 4.4% range, mainly because Fed it has frequently mentioned that it would maintain its restrictive policies until the inflation comes down. So like the Paul had mentioned, like the market, they are pricing in 3 rate cuts in 2024. And so basically what has happened, that when the Fed it has it when the Fed it basically it cut rates, the markets tend to drop. So this is like mainly because like when the Fed it continues to rise interest rates, and it keeps it there for a longer period of time, there is a recession, and then Fed is forced to cut down the rates. So like if I take a look at this chart, there are three instances in the past wherein when the Fed they started to raise the rates, when they started to cut the rates, the markets it had actually dropped, and there was a recession in the economy. So these are just an instances over the past, and it would be interesting to see what would happen next year when the Fed would actually start cutting down rates. So it would be interesting to see. Yeah. So moving on to our second sector macro theme, there are mixed signals, and various indicators they are giving in mixed signals. So like if we take a look at this chart, is basically the yield curve spread. So basically this is the spread, it's basically the difference between the 10-year treasury yield and 2-year treasury yield. So the yield curve, it has remained inverted the longest over the last couple of years, over the last the 3 decades or so, and it has remained longest for inverted for over a year or so. So what has happened, like basically when the yield curve spread it reaches zero, or it tends to reverts back to 0.5% on 1% range, there is the equity markets, they tend to drop, and there is an economic recession. So these are the two circles wherein the yield curve it reverted back to zero, and then it reached a 1% range, and then the yellow line, which highlights that there was a drop in the equity markets, and the shaded portion is the recession. So yeah, so it would be, I mean, basically difficult to tell that if in future, like if it reverts back to zero, but there would be a recession. It would be difficult to say, but I mean, if there is a gradual reversion, then it might not happen. So and the other the if you look at the other parameters, like the manufacturing PMI, it has been improving over the last few months. Like it's currently about I think hovering around 48 or 50. So it means that it has been improving. Whereas the services PMI indicator, it has remained resilient at 55, and this is mainly because of the high employment and strong hourly wage rates. So basically these shows that the manufacturing and services are strong. So it basically a mixed indicators. So moving on to the third macro theme, it's basically earnings headwinds to persist. So if we take a look at this chart, it's basically the forward earnings growth, earnings per share growth rate for the S&P 500 as a whole. We have considered the S&P 500 as a whole market, and the forward earnings per share growth rate, we expect that to market expects that to improve, but it's still hovering around zero or below that. So it means still contracting. So what basically if we take a look at the three red circles, so whenever the forward earnings per share growth rate it was below zero, so the market actually contracted. However, there is a slight disconnect over the last 1 year or so, and if we take a look most recently, there was a steep decline in the forward earnings per share growth rate. However, the markets they tend to still rise. There was some kind of weakness, pullback, but the markets they have still continued to rise. So in the future, we do expect earnings to grow, but there could be some kind of weakness because apart from, if we leave apart the Fangam or Magnificent Seven companies where the earnings are growing significantly, if we leave that, the other S&P 480 or 490 companies, they are still witnessing it's still being impacted from economic slowdowns, and their profits are not growing as much or are still flat. So yeah, we would expect some kind of weakness going forward. So if we move to our sector trends, first of all is that the EV deliveries they are heating up. So when we look at the left hand side chart, the total EV deliveries. So it basically we have combined deliveries for major EV players like the Tesla, BYD, Volkswagen, and as well as BMW and few Chinese companies. And basically these companies they command over 90% of market share, and just they are the proxies to the entire EV market. So like the EV deliveries for the companies as a whole, I mean, they have grown by about 90% CAGR over the last 2 years. And we believe that there are three key reasons for this. First of all, there is no shortage of demand for electric vehicles. And this is mainly because the electric vehicles, they have now, the electric vehicles they have improved in terms of higher efficiency. They are like more efficient, their range has increased, and also the technology has been more modern, and also the price for the electric vehicles they have come down significantly. So it's also more attractive for consumers, they are instead of the rising fuel prices, and like instead of rising petrol prices, instead of they would adopt the EV vehicles instead of the petrol powered traditional vehicles. And also secondly, also there is a the governments over the world, and they are pushing for electrification, and there are policies in place. So like they have been like in the US, the government it has been providing a tax rebate of $7,500 for the consumers when they buy the electric vehicles. And yeah, so I mean, the third reason is that the companies they have built up new factories, and they have ramped up their production capabilities, and as a result, like they are able to deliver more electric vehicles. So when we move on to the right hand side chart, percent of total vehicle sales, like currently 1 in 4 vehicles that are being sold are electric vehicles, and we expect this to improve to like 1 in 3 vehicles which would be sold, it would be electric vehicle by 2026. And this the reasons would be like as I mentioned earlier, like the support from government and policies in place, better efficiencies for electric vehicles, and price reductions. So when we move on to my next slide, so basically EV market, it's currently dominated by a few companies. So like this particular chart, it's interesting mainly because there is this narrative that the BYD, it's the largest EV player. So we believe that this might not be 100% accurate, mainly because they lump in a few hybrid vehicle sales as well. So what we did was we considered the pure play model electric vehicle models and their deliveries, and we found out that the Tesla it has a market share of about 37%, and the BYD it has a market share of 27% in the pure play EV market. But the market share for Tesla has come down significantly, but it's still the leader, and the drop in market share was mainly because of rise in competition. Whereas the BMW and Volkswagen, they have a market share of about 8% and 15%. So, and second stock sector pick would be semiconductors are showing early signs of recovery. So when we move on to this chart, it basically, when we talk about the semiconductors, basically we think about NVIDIA. So NVIDIA, it's the leading player in the GPU market. But there are also two other segments into the semicons, like the CPU market, which includes companies like AMD and Intel, and they basically manufacture chips for our smartphones, computers. And there is another segment which is memory. So the memory segment, it basically includes Micron, Samsung, and SK Hynix. So they basically manufacture the memory chips for devices and the hard disks. So the sales for CPU and memory segments, they have been contracting, and but we expect the recovery going forward in the CPU market, and it should reach flattish by about next year. However, the overalls as a whole semicon as a market, we are positive, mainly because it would be dragged up by the Nvidia, which has witnessed over 100% of its sales growth over the last year or so, mainly because of high generative demand from the generative AI for its chips. So moving on to my third sector theme, it would be that SaaS seems to have bottomed. So SaaS, it's an abbreviation for software as a sales service companies. So these companies, they basically provide their software over the internet, and they have a subscription based business model, and the revenues are recurring in nature. So we believe that the market, basically it's expecting a recovery in SaaS companies, mainly because of two reasons. First of all, most of the SaaS companies, they have high prices for their softwares because they have integrated AI into most of their products. So coming to the second point, so most of the companies, they have integrated AI into their product base. Like for instance, Microsoft, it has integrated it with Office 365, wherein in PowerPoint you can generate the first draft of presentations, whereas in Word you can generate a text via it would auto generate text for you on based on your requirements. So Adobe, it has also integrated, like it has a Firefly tool from where you can generate images from text-based prompts. So we if we take basically divided the SaaS companies into three segments, like the ERP, CRM, and productivity. So the green line is for productivity, and we have included Microsoft and Adobe. And if we take a look at this chart, it has consistently remained resilient, and it's the first one to witness recovery going forward. And this is mainly because there is strong demand for the productivity applications. And in order to remain competitive, enterprises, they have not cut down so much on their spending towards productivity apps as they have cut down on the SaaS companies, like like Salesforce, or the HubSpot, where they have witnessed like the cautious IT spending. So the productivity segment has remained resilient. So it's continued to expect recovery. Whereas for the ERP and CRM companies, we believe that it has bottomed out, and it should the demand for the products and the top line growth should grow in 2024, mainly because the cloud spending, it has bottomed out, and also the generative AI should boost demand for its products. So moving on to the my stock picks, like if we take a look at this chart, it's the Fangam as a whole. So the earnings for Fangam companies as a whole, they grew by about 45% in the September ended quarter. And like I mentioned earlier, this is mainly because of the cost cutting initiatives like the layoffs that most of the companies have done. And now it has been starting to take shape, and the full effects are starting to show. So as a result, the Fangam earnings, they recovered sharply this quarter, whereas for the December ended quarter, they as a whole, the Fangam sector as a whole, we expect a 8% expect a 8% revenue growth for the December ended quarter. So moving on to my stock picks, first of all, it's Microsoft. So we have the title, cloud continues to be the driving force. So for Microsoft, we believe that there are two key growth drivers. First of all, it's the intelligent cloud segment, and the second one would be the productivity and business process segment. So basically, the intelligent cloud, it would include the cloud service, which is Azure. It's the third largest cloud provider and has a market share of about 23%, and it has doubled over the last 5 years or so. So we believe that Azure, it should continue to gain market share from its peers, mainly because its integration capabilities with Office 365, and the company also claims that it has pricing power over AWS. And lastly, it should benefit from the shift to digital transformation trends, wherein the companies, they shift their workloads to the clouds. So over the last few quarters, Azure revenue, it has been growing by about 25 to 30% range, which has been significant. And any growth in Azure revenue, it should also help Microsoft to boost its profitability, mainly because it's a high margin business. And so moving on to our second investment thesis for Microsoft, there has been strong Microsoft. Basically, it commands a 90% market share in the productivity software market, which includes tools like Office 365 and Teams. So there has been continued demand for its Office 365 platform, mainly through the small and medium enterprises and front-end worker offerings. Basically, it's witnessing significant demand from commercial customers, mainly because of rising need to manage tasks and workforce. So the Office 365 revenue, it has been, despite the significant market share, it's still growing at about 16% range over the last few quarters, and we expect this to continue to gain by about double digit, mainly because it has integrated AI into its Office 365 tool, and we believe that it should give a boost to its top line. Lastly, when we look at the red line in the chart, it's basically for the more personal computing segment, and it has been declining over the last few quarters, mainly because there has been weak demand for the PC sales, and it has impacted its Windows and devices businesses, which basically includes its sales, like sales of PC accessories and tablets. So these have been impacted, and this particular segment, it also includes the gaming segment. So just to to note that the Microsoft, it would be benefit from the Activision Blizzard deal, and the top line, the annual growth rate for the top line, it should get a boost by about 3 to 4% from the Activision Blizzard deal, and it should benefit its Game Pass business, mainly because it will get access to the popular games like Call of Duty. So overall, for Microsoft, we have accumulated recommendation and 375 target price, and we believe that mainly because there is earnings visibility and stability, and it's well positioned to benefit from the digital transformation trends. So moving on to my second stock pick, Airbnb. We have the title, Booking Volumes Jump as Travel Rebounds. So Airbnb, it's basically an online marketplace for the unique stays and experiences. So if you take a look at this chart, in FY22, the booking volumes were 394 million, and it has already surpassed its pre-pandemic levels. And Going forward, it's expected to report record high booking volumes, and for 2024 we expect its volumes to grow by about 15%. So the volume, it has been reporting record booking volumes, and we believe that there are three key reasons to it. Like first of all, guests, they are staying for longer on Airbnb properties. Like the stays of over 28 days, they account for about 18% of the overall booking volumes. This was mainly because of flexibility due to remote work environment. And secondly, it's also witnessing a strong demand for the cross-border travel demand, particularly to the Asia Pacific regions after the COVID-19 restrictions have eased. And the third one is that guests, they are returning back to urban cities and from the non-urban locations. And the Airbnb, it has reported made a net profit last year of about $2 billion, and we expect it to continue to be profitable, mainly because of strong top line growth as well as strong top line growth as well as due to the high operating leverage. Secondly, the key point for Airbnb is that the active listings, they have been significantly growing on its platform. So in the third quarter, company said that the active listings, they grew by about 19% year on year, and they currently have about 7 million unique listings. So this is mainly significant, and the major reason for this, we believe that it's mainly because the company, it has been continuously adding in upgrades platform and adding in new features like the Airbnb rooms, monthly stays, and also providing support and marketing to hosts. And second reason could be that the hosts, they might list their properties on Airbnb in order to earn additional income. For Airbnb, we believe that next year the average daily rates, they could remain under pressure, mainly because the daily rental rates, mainly because mainly because there is a business mix shift towards the urban locations, which I mentioned earlier. So like urban locations, they are the properties in urban regions, they are smaller in size, and as a result, they command the lower daily rentals as compared to the non-urban locations, which are large. So this could basically impact its daily rental rates. And secondly, we believe that travel, it's a discretionary spend, and any if a guest, like it pulls back on its travel spending, then it might impact Airbnb's volumes. So overall, for Airbnb, we have a buy recommendation and a target price of 157, and we believe that it should benefit from the adoption of alternative accommodations, and it's more group and travel friendly and also cheaper as compared to hotels. So moving on to my third stock pick, Salesforce. So Salesforce, it's basically a software as a sales company and generates 90% of its revenue through subscriptions. So Salesforce, it basically helps companies to handle their sales operations, provide enhanced customer relationships, and also it has expanded into marketing and data analytics solutions. So for Salesforce, the key benefit is that it's currently focusing on multi-cloud adoption trends. So like basically there is strong demand for its products, core products like Sales Cloud and Service Cloud. So what company it is doing that, so what Salesforce is doing that, it's through its customer 360 platform, it basically bundles it different products under one platform, and wherein the customers, they would get a 360-degree view of their customer interaction across the various segments. And also it would benefit the customers, mainly because instead of managing various vendors, they would just have Salesforce like as a one vendor, wherein they would manage their sales functions as well as service and marketing solutions. So instead of various vendors, this would be just with one vendor through customer 360 platform, and it will also be cost effective for them. So secondly, Salesforce, it has recently announced a price hike of about 9% recently, and this was the first hike in over the last 7 years or so. So this was mainly because company believed that it has increased value to its customer base, and as a result, the price hike, and it should give a boost to its top line growth. So basically, Salesforce has also integrated AI into its product base, like the Sales Cloud, Service Cloud, wherein it would generate personalized emails or personalized chat replies. So, in order to help these salespersons to work more efficiently. And the third thesis for Salesforce is that the margins has been expanding, like from 3.3% in financial year 2023. We expected to grow by about 18% to about 18% for in FY25. Salesforce is basically a Jan-ended company, and we expect its bottom line also to margin to grow by 0.7 to 13.4%. And the key reasons would be that the company has been focusing on cost cutting initiatives like layoffs and real estate consolidations. So basically, the Salesforce it had laid off about 10% of its workforce earlier this year. So overall, for Salesforce, we have an accumulated recommendation of 242. We have an accumulated recommendation and a target price of $242. So moving on to my next stock pick, it would be Alphabet. So for Alphabet, we basically have the title advertising monopoly, and this is mainly because it's witnessing recovery in its digital advertising spends. So digital advertising revenue. So it seems to have bottomed out. Like if we take a look at the left hand side chart, which indicates the ad revenue year over year growth. So there was a steep decline after second quarter of 2021, and it actually contracted in the fourth quarter of 2022. However, last 3 quarters it has been the uptick, and in the most recent quarter it re-accelerated to 9%. So we believe that the initial steep decline was mainly on the fears that the consumer spending it has been declining, but it has remained resilient, and we believe that in 2024 it should reaccelerate further, mainly because it has mainly because the advertisers they mainly because companies they further advertise their products, and also because Alphabet it has a monopoly in this, like 90% of the online search that happens on its Google platform, and as a result we believe that it should benefit from digital advertising trends right now. Secondly, the Alphabet it's leveraging heavily on AI to drive better products and to increase monetization. So for better products, we basically mean that the company is relying on generative AI like to for better ad placements, intuitive ad placements, and it has also integrated AI into its Google Cloud platform, which is the third largest cloud provider. It has a market share of 10%. So wherein apart from the cloud service through it has integrated AI, wherein it's providing additional services to its users like data analytics tools as well. So it has been integrating AI into its products, and in terms of higher monetization, we think that there's a largely untapped platform, which is the short form video shorts, which we believe it's highly untapped, and it could benefit by placing ads over there. Like after every 2 or 3 videos, it can place an advertisement. And also, we believe that there for Alphabet there is a key opportunity, which is like the YouTube platform. Like there are nearly 2 million content creators, and over a billion a number of hours are watched daily over there. So this is also the opportunity wherein it could benefit from the advertising spend over there. And in terms of the last point for Alphabet, it would be like it has, like the other tech companies, it has been focusing on high operating leverage to boost its profitability. And its operating margin, it has come to for the currently about 30% as compared to its pre-pandemic levels. So for Alphabet, we have overall have a buy recommendation, and this is mainly because we believe that it should benefit from the recovery in digital advertising. So moving on to my next stock pick, Tesla. So we have the title driving on electric future. So for Tesla, it basically have superior products as compared to its peers. Like BYD, it is strong, but we believe that it's more focused on mass market instead of the high and premium automotive markets. And secondly, there is no shortage of demand for the EVs. Like the Tesla deliveries, they have been growing like about 50% year on year. But there was some kind of weakness over the last 6 months or so, and this was mainly because of factory shutdowns. But the deliveries are still growing significantly, and also the wait times have come down significantly for the Tesla EVs. Like the wait times, it has come down from 6 to 9 months previously to 1 or 2 months right now. So this was mainly because of the ramp up in the production capabilities. And secondly, for Tesla, they command industry leading margins, wherein like they have a gross margin of about 18% as compared to the peers, like they have about 9 to 10%. And we believe that this is mainly because they have been focusing, like they are currently looking forward to more efficiently produce their vehicles by simplifying their designing for the cars. And the another reason is that the cost per electric vehicle, as it has also come down. Like it has come down from about 75,000 in maybe 2017 to currently about 40 or 45,000 currently. So the significant drop in cost per EV, it's mainly because the 1/3 of the cost comes from batteries, and through R&D, through better R&D, and they are able to manufacture more efficient batteries which last longer and does not overheat as compared to peers. And lastly, this is not a tailwind for just for Tesla, but the entire EV market. So like there are government policies like zero emission policies. The government has been pushing for electrification, like I mentioned earlier. So they have also been providing subsidies to manufacture EV vehicles. So like as more and more policies are in place, it should benefit the overall EV market. And for overall for Tesla, we have a accumulate recommendation mainly because there is more brand loyalty towards it, especially in the US and Europe. So moving on to my next stock pick, which is Amazon. So for Amazon, it's basically margin expansion. Like its gross margin, it has expanded from 43% to 48%, 50% range, and similarly, the operating margins are significantly increased. So like even Amazon, they have earlier this year they have laid off about 27,000 of its employees, and this was one of the reasons for its boost in margins. So, and the second reason is that the Amazon, it has more costs associated with its logistics costs, like the costs it has to incur in order to deliver those parcels to the consumers. So we believe that the logistics costs, they should continue to improve, mainly because of the fuel prices have come down now, and also because of easing supply chain. So this should further benefit Amazon's margins. And secondly, the margin should also grow, mainly because it's AWS, which is its cloud service. It's the largest cloud provider and has a market share of 33%. So any growth in that segment would as it's a low high margin business, would benefit Amazon. So like Google and Microsoft, Amazon, AWS growth should also accelerate, and it should benefit from the generative AI adoption. Like as the companies they integrate AI into their products, they might not have the resources to build on data centers, so they might just buy AWS subscription and pay monthly and leverage on AWS services. And the last point for Amazon is that we believe that it's they have a significant opportunity in terms of advertising. So advertising, it accounts for about 10% of its overall revenue, and and in the most recent quarter, advertising revenue, it grew by about 25% or so. So we believe that they have opportunity mainly because they have access to the first party data, like wherein if we go to Amazon, whatever products we buy and whatever we are looking for, Amazon has access to that particular data, and through that data and generative AI, we believe that Amazon would be in a much better position to recommend more better products to the users, whereas the peers, we believe they might be using third-party cookies which would be difficult to interpret. So at least over the next 3 or 5 years, we believe that they have an opportunity in the advertising segment. And overall for Amazon, we have a buy recommendation and a target price of $190. So moving on to my last topic, NVIDIA. So for NVIDIA, it's basically the leader in generative AI, and this is mainly because as the companies as the several companies they integrate AI across their product base, they have to run those products through the GPUs, and the NVIDIA it's NVIDIA it's manufacturing the best GPUs, and which they have the capability to go through the large datas and to more high intensity products, to analyze high intensity products. So we believe that NVIDIA it's producing the best specs and best tech. And also we are expecting a strong demand in the second half of 2024, mainly because they have order books filled in until the end of next year. And secondly, we think that margins they continue to expand for NVIDIA, mainly because they are selling their new generative chips almost twice the price as compared to the older ones, and we believe they are able to command such high prices mainly because they have a monopoly in the GPU segment, and they have the best GPUs that they manufacture. And for NVIDIA, lastly, we believe that NVIDIA, it has reported their results recently, and they stated that so basically NVIDIA, it generates about 20% of its revenue from China market, and the company it recently said that in starting in fourth quarter, the US curbs that the US it's imposing curbs on its sales to the China market. It might be impacted starting in fourth quarter. However, we believe that it might not significantly impact its top line, mainly because the demand for generative AI chips, it's not just coming from China, but it's coming from all over the world, like the US and UK. So for NVIDIA, we have a buy recommendation and a target price of $645, mainly because they are the leaders in the generative AI segment. So this is basically a US stock coverage list. We currently cover about 17 companies, mainly into the technology sector. And as we expand our resources, would be expanding our coverage into other sectors. So that brings us to the conclusion for the US session. So like to conclude, first of all, we believe that earnings headwinds should persist into 2024. And particularly for the companies apart from the Fangam or Magnificent Seven, mainly because they are still witnessing the impacts from the economic slowdowns. Secondly, we expect Fed to remain to maintain their restrictive policies at least for a longer period of time, as they pass at least until the inflation comes down. And lastly, the AI related stocks, we expect them to continue to cool down, mainly because they have significantly run up in the second quarter after the hype, and the valuations they have, and the investors, they have really realized that they are trading at high valuations, and at least some of the companies, they are not even generating the money. So we expect some kind of cool down in the AI related stocks. So that comes to the end of my presentation, and would like to pass it on to Brian.
All right, thanks, Ambrish, for the presentation on the US segment. And yeah, I'm just gonna pass it back to myself real quick. And all right, so a big thank you again to Ambrish. And now we will move on to our Q&A section. So if you have any questions that you want to ask Ambrish, do type them out. Here we actually have a few already. So let me just get that. Oh, sorry. All right, so I shared the wrong screen. All right. Okay, so I'll just read out the questions for you, yeah, Ambrish?
Yeah, sure. Right.
All right, sure. So we have one from the audience, which is the EV sector going to see some downturn as there are signs of big EV companies not following to SDG standards?
There should be some kind of weakness as the competition has risen, but I'm really not sure what does SDG standard means. So I'm not sure if Paul would like to add in over here.
Oh, SDG probably means the sustainability development goals. Kind
Okay,
of like
okay.
in
So
that.
there could be some kind of weakness, but I mean, yeah. So as more governments have policies like zero emission policies and so on, the incentives and the subsidies that they have been providing, it overall over the next 5 years or so, the EV market should be positive.
I see. All right, so we'll move on to the next one. What are your thoughts on the news of many semiconductor ETFs being shorted by many hedge funds and big players?
So, like I mentioned, the demand for generative AI chips, like in the second quarter, there was a hype, and as a result, the stock prices have risen significantly. And as the estimates, they have come down to a more fair basis. So, as a result, we believe that they might have shorted the ETFs.
All right, sure. Thanks, Ambrish. Next up, we have stocks like Microsoft Alphabet has been trending up to historical highs and their valuation are very stretched. Does it make sense to invest now as their TP are already reached, or should we wait until recession and correction likely next year, as shared by the first presenter?
If we fundamentally look at the stocks, they have reached their target prices, but they should benefit from the trends like digital transformation trends and the growing demand for the cloud-based products. This is not witnessing any slowdown. They have also bottomed out, and as the companies they shift their workloads to the cloud, it should continue to benefit Microsoft. And also for Alphabet, it should benefit mainly because they have a monopoly in the digital advertising space, and they have a monopoly wherein 90% of the online search comes through Google. So as there is a recovery over in digital advertising, we believe that fundamentally these two stocks are the good stocks to buy. Whereas technically, not too sure if I can comment on that.
All right, sure. Thanks, Ambrish. We'll move on to the next question, right? In your view, what would be the weaker performing sectors or companies in the US market going forward into next year that we could potentially look at shorting as part of our portfolio?
So right now, we believe that when there is a when there is a high inflation, like it would impact companies like the fintech companies, wherein there would be lower consumer spending on their platforms, and it would indirectly benefit their revenues because they generate what would be the like the companies like PayPal, like it generates about like it's currently witnessing lower trading volume. Sorry, it's witnessing lower processing volumes on its platforms, and so we believe that the companies like fintech, it might be impacted because of the economic slowdown, which might impact the lower consumer spending.
All right, sure. Thanks, Ambrish. Let me just give the chat box another look. And yeah, I think due to time constraint, I think that should be it for the Q&A section. Thank you, Ambrish, once again for your presentation and for the answers in this section as well. Very much thanks to you.
Thank you, Brian.
Oh, thank you, Ambrish. Thank you. All right, so yeah, I think I will do the closing for the webinar. Unfortunately, we've come to the end of our main content for today. So if you are interested in opening an account with us to trade any of the stocks that the speakers today have shared, you can scan this QR code to open an account, or you can contact any of our representatives after the webinar. With this, this is our social media platforms. We have Facebook, YouTube, which this webinar will also be uploaded to, because this is a recorded session. We have our Instagram as well as our website, where you can get more information on our company. And yeah, these are the contact informations for the branches across Malaysia. So if you are interested in getting to start trading with us, you can contact any of the branches here, and the representatives will answer any of your inquiries and your questions. I'll just stay here for just a bit more. Yeah, all right. So a big thank you to our speakers once again, Jen Yuan, Ambrish, as well as Paul. And thank you all for coming to join this webinar. I know it's a Saturday, morning. Most people will probably want to do other things, but here you are, deciding to take a more eventful and beneficial start to your weekend. So a big thank you to all of you as well, and thank you to our speakers for taking the time out of their schedule to be the speakers at this event. And yeah, thank you all. I will see you guys soon. Have a great weekend.